Interdependence is not only theoretical, it's very real. A couple examples for you this afternoon. First is on energy. Quebec's, as some of you may know, Quebec's hydroelectric network delivers clean, reliable power to New York and some other regions in the US and has been for decades. But starting from spring 2026, an extra 1,200 megawatts will be delivered from Hydro-Quebec to New York. It'll be low-cost, renewable power directly delivered here in Astoria for the New York Metro area starting of next year. And that's just proof of how disciplined capital, infrastructure, and joint commitment can advance both sustainability and competitiveness north and south of our border. Second example is in defense and security supply chain. Quebec's firms play a growing role here in advanced manufacturing, in aerospace. Some of you will know, obviously, our main flagship, Bombardier, but CAE, who was here last year as well. For those who don't know, CAE actually trains every single airman and airwoman in the U.S. Air Forces, may that be through simulators or classroom, and they've been present here for decades. All the way through strategic technologies that really support directly North American security. And that's from precision engineering, industries, specialty materials that really complement U.S. capacity. And third, I want to put some emphasis on critical minerals, something we've been talking about for a long time in Quebec, but that's increasingly important right now. Quebec holds some of North America's most important deposits, essential for batteries, semiconductors, advanced defense systems, and most of the province deposits are among the 40 mineral commodities considered as critical by the U.S. Through the Geological Survey report that came out a couple of years ago on critical mineral. Quebec has currently 21 active mines producing a variety of essential minerals and 50 advanced stage mining projects, including 32 focused on critical and strategic minerals. We're working with partners across the U.S. like you all here to ensure that these resources are developed responsibly, sustainably, and in support of our shared strategic goals over the next years. Now, together, these flows of trade, of capital, of people, of resources, and innovation really form a genuine North American investment corridor that's low in carbon, that's high in trust, and that's built for the future. Quebec is proud to lead among some national governments in international engagement, proving that leadership doesn't stop at our national borders. In fact, just last week, Quebec's Premier François Legault and New York Governor Kathy Hochul signed a declaration of friendship in Quebec City last Saturday, reaffirming our shared commitment to sustainable growth, clean energy, and the prosperity of our citizens. And now, of course, for those who, hopefully, all of you know that there's two very important meetings happening today regarding Canada and the US. One that just ended a couple minutes ago in DC. Another one that's taking place tonight. And as it was referenced earlier this week, and this meeting tonight is between the Yankees and the Blue Jays. I'm sure you've heard this morning. But with all what's going on, let me conclude on one recommendation that was made over the weekend. Let's keep the rivalry between our two nations where it belongs, on the ice, in the field, because of the field, our economies are very much on the same thing. Thank you very much. Have a great afternoon.
Please welcome to the stage Paul Goldberg, Director of Research and Senior Equity Analyst Financials for Bloomberg Intelligence.
Good afternoon, everybody. I hope you guys had a good lunch. I oversee the equity research for the Americas, and I just want to give you a quick flavor of the research that's available to everybody in the room on the terminal. So Bloomberg has three research legs: economics, Bloomberg Intelligence, and BNEF, operated by about 900 research professionals. Moving on, within the Bloomberg Intelligence, where I work, there are about 500 professionals, 600 data providers. We cover almost 2,500 companies. You see the 2,300 here in the slides, but that's only equity. We do cover credit, and we have big expansion plans right now in the works. Jumping into the BI homepage, you can navigate into research on the companies. You can navigate into the themes. You can hit the directory and talk to the analyst. So the analyst, like a sell-side analyst you typically would talk to, You can get the information, you can get their insights, anything interesting for you on the page, you can get there. You can also set alerts for anything that's interested, drill down, and it will come up for you on the terminal. Moving on to the companies, I did mention the companies. We cover 2,300 equities plus. Included in those are Canadian equities, which we cover roughly 1/3 of S&P TSX names. I do cover banks myself, so Canadian banks. Here's an example of the company primer, which is sort of think of an initiation report that's perpetually lives in the terminal and perpetually being updated with company catalysts, financial information, earnings reviews, previews. Everything is moving at the same time. You can use the left rail to navigate adjacent research. I did put the national bank slide up on here, so that's kind of an interesting one. Moving on, just to give you a little bit of a flavor thematically within banks, and you probably heard it in the last number of hours, there is a trade concerns, there are trade issues, the loan growth has slowed down, the interest rates have been coming down, the credit has been deteriorating slightly, but not to the levels of significant concern. We've seen it in the past. That said, the banks have been extremely resilient. You see they've been up 20+% this year, and in fact, very recently they started to outperform TSX itself. I did mention the concerns. The other things, very strong levels of capital for the banks. The average for the 6 banks in terms of the capital ratio is about 13.7%, so it's extremely strong. They have a lot of capital to deal with any sorts of issues, even if we do end up with a recession or something worse. Also, within all the company coverage, we do provide company models. So those are models built into the terminal, curated by the analyst. You see the consensus estimates, our estimates in there. You can download those models off the terminal, manipulate, make your own adjustments, make your own assumptions, and so on. I do want to move into the adjacencies a little bit. Bloomberg Economics, BI Econ page. We do have coverage of most countries around the globe, including Canada. Very easy to navigate the page, getting a very quick look at the companies. So our Canadian economist thinks there is somewhat of a concern in immigration slowing down, and he thinks that it can potentially have the growth of the GDP over the next decade. With that in mind, he thinks still the Bank of Canada policy is not accommodative enough. We should see more cuts. Also, we do have a rate strategy, credit strategy. We have an equity strategy. Here is an example of our equity strategist work. They do think that gold has been helping the Canadian market quite a bit this year, and they do expect that there's going to be more coming from it, more help driving the TSX higher. To step back and give you a little bit of a flavor broadly, we do not only write to the terminal in a very quick and digestible bites, we also write a lot of thematic research. So if you go to the BI Theme Go, you can get into the themes from ESG to energy to financials and work on the specific topics that might be of interest to you. The left rail, obviously, for navigation. The additional thing that I do want to leave with our deep dive reports. Those are on the terminal, but they're also available. Those are longer, sometimes 50, sometimes hundreds of pages reports that dive into specific issues or industries. These are usually kind of longer term perspective, very thematic, and can help you navigate longer term themes from AI to private credit to things like that. With that in mind, I just want to say thank you. Thank you, everybody, for being here. And please reach out to Bloomberg Intelligence if you have any interest in particular topics. Thank you.
Please welcome Anne Flori, Senior Funding and Investor Relations Officer at the Council of Europe Development Bank, Sydney Siahaija, Head of Funding for BNG Bank, for a conversation with Bloomberg's Chunzi Shu.
Hi, Anne. Hi, Sydney. Good afternoon, everyone. You're both global issuers. When you pick a currency for raising debt in, is it all about funding costs for you, or are you trying to balance that with diversification?
Good afternoon, everyone. Thank you very much for welcoming us on the panel. And to answer your questions, it's a mix of both. We would very much look at investor diversification at all points in time because it's key for us. It enables us to access every market at any point in time and never face market closure. Cost is also something we keep at the forefront of our mind when accessing different markets, because obviously we will have to, this will impact the lending side of our business. We always want to be very competitive on the lending side, hence we need to be competitive on the funding side. So it both goes hand in hand. The more diversified we are, the more competitive we are in terms of pricing as well.
How about you, Sydney?
So yeah, first of all, thank you very much to Bloomberg and to the National Bank of Canada for welcoming BNG on this panel. When it comes to currencies, you know, BNG is a Dutch public sector bank. We serve clients in the Dutch public sector. So they are asking for euro loans. But of course, given that we don't have any retail clients, it's very important to us to have strategic access to the money and capital markets across the globe. So euros and dollars are our primary currencies in which we have a commitment to maintain our benchmark funding curves. But of course, we are also active in other currencies like Canadian dollars and also sterling and Swiss francs, to name a few. And those are also important sources of diversification for us. Now, just as Anne mentioned, for us it's also important what the price is, because only if we can get the most attractive funding, we can give our clients the best financing available. But of course, getting the strategic access sometimes means that you have to pay up a little bit to maintain good access to different capital markets and have good relationships with the investors.
So how much would you say, how many basis points would you give up to maintain that relationship in general? How does that calculation take place?
Would you want me to take that question? I can definitely. We don't think exactly that way. We tend not to so much view as a pay up. We look at markets in different silos. So we've got our benchmark markets, which are obviously very traditional. We're not very innovative on that front. It's euros, dollars, and euros. And then we would have what we call strategic markets, which are sterling, dollars, Canadian dollar, and Australian dollar. We're calling them strategic markets because they're actually providing us with a strong investor diversification. And because we tend to see in these markets investors we don't see elsewhere. For these markets, we would want flat-ish to what we can get in our benchmark markets. That said, if it's within a couple of basis points, we can have some flex, but it's not written in stone. It's very much a moment decision. It's depending on how it's very much depending on the type of investors and that are behind the transaction. I'm going to give you the example of our Canadian transaction a few years back. It was very much because it was an ESG demand on the back of that, driving that transaction, and that's essential to us. Hence why we could show some, we could show some flex in such instances.
Is that the same for you, Sydney?
I think very comparable in the sense that you have to think strategically about these decisions, because of course, if we want to help our clients make social impact, they can only do so at the most attractive financing terms. When it comes to a specific decision, it will depend on whether we think that a transaction will give us better access to that market, maybe in the near to medium term as well, where we might be able to do further taps of the new line that we create at levels that make sense to us.
It's been a few years since you've been in the Canadian market. What conditions are you looking for to come back? Maybe start with you, Sydney.
Yeah, so indeed, unfortunately, it has been 3 years now since we have been active in the Canadian market. Of course, that doesn't mean that we haven't been active with our Canadian investor base over that period, because we have been in Canada every year and we have done investor work. And fortunately, our Canadian investors are also very active buyers of our paper in, for example, euros and dollars as well. Now, we certainly hope to be able to be more active in Canadian dollars going forward, but unfortunately, the cross-currency basis has made it on the expensive side, I would say, over the last number of years. So we'd certainly look for that to be within shooting range of euros, which would be the benchmark for us.
Anne?
And yeah, I was going to say, I can only echo what Sydney's saying. We look at the market the same way. So we're never very far, ever, from the Canadian investors, in the sense that we meet them at European conferences, or we meet them in Canada or in the US. So we are in regular touch with them. So we tend to see some of them in our international, in our other benchmarks, but we are very much monitoring the markets with the help of our Canadian banks, mostly to see whether there's an opportunity for us to come back on the maple market. But that would have to be closer to not as big a gap.
You both sell a lot of ESG label bonds. What is your perspective on Canadian investors' attitude toward ESG compared with elsewhere? Maybe start with you, Anne.
Yeah, you know what? I have to say that I've always considered the Canadian investors quite sophisticated in that front, be it by construction and who they are and the country that they live in, but they were very much into green. And when it comes to social as well, because we do issue social bonds, it was when we met with investors on that front, be it virtually or physically, they were very sophisticated, very key questions. And you're talking about some of the Canadian bank treasuries or else, very well advanced. I will have to say, a few years back, when we then went to see some US investors, the difference was really major between the two investor type. Now the gap has narrowed, but still, I have to say that's something we wouldn't really think issuing a Canadian bond without a label, because we know there's a strong demand there, or at least there was a strong demand there for specific labeled bonds.
Yeah, definitely agree on that. So our understanding has always been that issuing a bond in Canadian dollars should mean that you also put a label on it, given that demand from Canadian investors in that regard is very strong. Now, we've also been in active discussions with Canadian investors on, for example, social housing, which in the Netherlands is an important topic for society, and it also has a political angle as well. I think a lot of the discussion around immigration, cost of living is very much related to housing affordability, and BNG is trying its best to help our social housing association clients in the Netherlands to provide social housing to low-income households. And our understanding is also that in Canada, this topic is very much relevant, and that social housing is also definitely something that Canadian investors want to invest in.
Can you give me a sense of how much it costs to put an ESG label on a bond, and are you usually able to pass that through onto the investor?
If I may take that question, I would say that the famous greenium that we could call socialum when it comes to social bonds doesn't exist. It's a myth. So there's no, you don't pay up to, at least to buy our social inclusion bond, because we decided. The only reason why it may come more expensive is because there's more demand and there's then more tightening afterwards. But there's no decision from the issuer to actually have a social bond more expensive than its equivalent in conventional format.
But it is more expensive to issue because of the tracking and reporting process, or no?
No, not on our side, especially given that we are working under a portfolio approach. So it's based on our portfolio. And remember as well that we are a social issuer altogether. So it's true that our social inclusion bonds are to finance projects in 4 of the 10 sectors we're active in, but nevertheless, we monitor all our projects. We just put the projects that are part of the portfolio of the social inclusion bond portfolio into one side. But it's a little bit of more work indeed with all the reporting and stuff. But no, it's not passed on to the investor. It's actually borne by us.
That's what I figured.
And really very much part of our day-to-day business, because we really want that market to grow.
What's your perspective?
Well, so I would say, looking at costs on the issuer side, obviously we make impact reporting available for our ESG bonds, both our sustainability bonds and our social bonds, on an annual basis. The transparency that we provide here, that we want to give our investors, I think it's very valuable. Obviously, that does come at some administrative costs, but I think that's happily borne by us as an issuer, because not only do we want to be active in ESG labeled bonds, but we also think it's very valuable to our investors and to the relationships that we have with them. When it comes to the bonds themselves, just like Anne, we don't typically see much of a premium. It's hard to measure it either way. You would really have to issue a non-labeled bond next to a labeled bond in the same maturity on the same day, I would say. But what we do indeed see is an increased amount of orders and also larger orders, leading to stronger demand. And we have had the feedback many times from investors that liquidity, certainly when you're looking to sell the bond, is very strong for our ESG labeled bonds.
How can the Canadian market, or any market for that matter, become more international, more diverse, and less insular? And what's the argument for being that way?
Yeah, so maybe if I could just provide some thoughts on that first, then I would say the Canadian market has certainly become more international over the years. If we look at other examples of markets that have done so, if we look, for example, at the Australian dollar market, then we see that many issuers have come to that market, not just from Europe, but also from Canada in recent years. And also vice versa, right? So we're now seeing the Australian SEMIs coming to Europe, issuing benchmark transactions in euro. And I think this cross-pollination, if you will, only helps to internationalize a market. And we've certainly seen that with the increases in order book sizes over the years in Australian dollars. Now, that's not to say that we don't also see internationalization in the Canadian dollar market. But I think it definitely helps if the market circumstances are such that issuers are able to issue on a consistent basis in the Canadian dollar market, and Canadian dollar issuers, which they have been, are active abroad as well.
I can only echo Sydney. I think the one line, if Canadian issuers can issue internationally, that would put some positive tension on the cross currency, and that would help us. So that it would be more interesting for us to issue in Canadian dollars. But half a joke aside, I think that's very much that's a very much a dual way road. Everybody has to be active, and not only the international issues, also because the market needs to grow a little bit to be able to welcome all the international issues. Also, it has the I don't know about you, Sydney. I know that the investors investing in international issues are, for the moment, not that many. The difference with Australian market that you just mentioned is that now you've got a larger group, even of domestic investors investing. So I think that has to grow, and for that they need to. They need to be happy to pay at least flat $2 and not expecting a pickup $2.
Are
I
you
think indeed, just maybe to reflect on that. What we definitely have seen is a very international buyer base as well, investor base for these Australian dollar transactions, whereas perhaps in Canadian dollars, the buyer base that we have seen for our transactions in the past was more on the domestic side. So when that also grows into a very much international audience, that definitely helps to deepen and broaden the demand for new bonds.
Are you looking at new currencies and markets for opportunistic issuances?
So I may take that one. Indeed, we always are, in the sense that, as I said in my first sentence, we always, at the opening remarks, we always want to diversify as much as we can, markets and diversification, to be able to get the best of the markets in terms of pricing. And investor diversification. So we would look at every new bucket of demand, new product. So that includes SOFR FRN, that includes different currencies, and we have been discussing rupee in Indian rupee and Mexican peso, new currencies to our toolkit. So we are always open to new products and new currencies.
Is the rupee attractive to you too, Sydney?
Well, it's not something that we have issued in, recently or at all. But we certainly also keep an eye out for interesting opportunities to broaden our toolkit, as Anne put very well. So certainly looking at various currencies, but also types of bonds, such as being active in callable non-euro bonds is something that we're currently looking at, which I think would be a great addition to our issuance spectrum.
You're both highly rated issuers. Are you seeing a flight to safety from investors, and are you benefiting from that?
Oh, yes. I have witnessed that investors, it's an ongoing trend, but it's growing trend, that investors are, for some obvious reasons, probably turning their back to some of the govies. I won't quote France, but it might be that they've got an issue with the credit right now, or maybe the US or any, they want to be, from what they say, want to be less exposed to govies and probably want to go into more safe haven. And we are, to their words, I'm not pretentious enough to say that for myself, but we are more of a stable credit. And less subject to political turmoils and geopolitical tensions. So we do see some flight to quality. We do see some investors reducing their investment universe, and we're still part of it. And we get a lot of requests to get some taps or private placements, knowing that we're quite well advanced and won't do a benchmark before year end.
Oh, how much reverse inquiry are you seeing at BNG?
Oh, no, I'm going to leave that to you, Sydney.
Yep, sorry, and that was for you, sorry.
Certainly BNG is also typically being an institution that can be qualified as a safe haven due to the strong link with the Dutch sovereign, which very much also is a safe haven, given its 45% debt to GDP, quite an exceptional number in, I would say, these times where we see debt to GDP ratios go up due to increases in defense spending and other additional expenditures. we see as BNG quite a bit of safe haven demand when markets are stressed, especially on the shorter end, on the not just on the shorter bonds, but also on the commercial paper side as well.
Well, thank you both very much for joining me, and thank you.
Thank you very much.
Thank you for having us.
Please welcome to the stage Eric Girard, Minister of Finance of the province of Quebec, for a conversation with Bloomberg's Mathieu Dion.
Bonjour, Monsieur Girard.
Bonjour.
You've been finance minister for 7 years now, but you really follow Canada's broader fiscal picture closely. So given the persistent tariffs and a projected federal deficit that could range between $70 billion and $100 billion, do you have any concerns about Canada's fiscal outlook?
I think it's obviously a very important exercise. There hasn't been a true fiscal statement for Canada in a long time, so there will be a lot of interest. So no matter what the initial number is, the deficit for the current year, I think it's very important that we see a downward trajectory with respect to deficit and a credible plan as to bring this to a sustainable path.
And if you look at the economy, do you base your assumptions on the idea that the tariffs could be in place for a longer period of time and that sectoral tariffs could actually remain in place?
Well, we're going to update our economic assumption, but when we did the budget, we assume on average 10% tariff for 2 years, always under the rationale that if you exclude energy, the U.S. has a trade surplus with Canada. But we need to be mindful that if tariff were to be permanent, the economic impact on the structure of the Canadian economy would be permanent. So we really need to go through the bottom of this and find common ground and a solution that is optimal for both. What has been a very successful economic partnership, we need to go back closer to where we were, certainly.
I just want to talk about the federal budget that's going to be released on November 4th. So the government plans to release their budget and their major fiscal documents in fall instead of spring. Does that change anything for you?
Well, the timing is for them to choose. Obviously, when they used to do February budget and all provinces and territory were in March, it was just fine. But since the pandemic, their budget came always later. So the move is interesting. But what's really important for us is the content of the budget. The timing is a bit of a side issue. We need an infrastructure program that will help province and territory face the great challenges that are associated with population growth. We need more school, more hospital, more housing, and the federal infrastructure program is expired since December 2023. They're the AAA credit. There was a program to the tune of $10 billion a year. So for Quebec, this represents close to $2 billion a year. We're looking for help in infrastructure from the federal government, and we're all on content, not the timing.
Any other expectations from this budget?
I'm expecting a federal infrastructure program that is helpful for province and territories.
So the message is clear here. Quebec's economy is heavily exposed to trade.
Correct.
So you have minerals, aluminum, 50% tariffs there, lumber. I don't know where it is right now. I think it's 45% in total, or likely to become 45%. Dairy product is at risk, aerospace also. Have you seen measurable impacts on Quebec's economy aside the contraction in GDP we saw in the second quarter?
Yes, we do. We're seeing all over Canada capital expenditures are really weak. Because of the uncertainty, and people need the certainty with respect to the access to the number one consumer in the world. And therefore, the uncertainty period is reducing capital expenditure, it's reducing export, obviously, given the tariff. So we are seeing impact. We are seeing also that originally the weakness in the labor market was in these sectors that are related to trade. Now it's spreading. It is a summer job for students. It's all over the economy that we're seeing weakness slowly spreading. So we're at the core of the weakness. Q2 was a negative bounce back from the strength of Q1, and now Q3 is going to be difficult. And we expect that Q4 is going to be difficult for the US. And if we collectively want to have a good 2026, then we need these tariffs to be lowered.
From a fiscal policy
or
perspective,
eliminated.
You'll release...
Even better.
So from a fiscal policy perspective, you'll release an update, I guess it's in November. Are you planning any measures to help Quebec companies to remain competitive, considering that in the US they're lowering taxes, that in the US they have an incentive actually to stay in the US and produce in the US? Could you lower the fiscal burden for businesses in Quebec to help them thrive and remain competitive, considering the situation?
That's an easy question because we already done that. The federal government announced that they were going to bring back accelerated depreciation for capital expenditure. We've announced that we will harmonize, and now the federal government needs to table its legislation, and therefore all corporations can have certainty with respect to capital expenditure.
But could you do more on the top of what was announced?
We can always do more, and when you're in politics, there's infinite demand for limited means.
Okay.
The federal, let me answer this. If the federal government wants to lower corporate taxes, that would be helpful to Quebec Corporation.
Okay, another message here. In your March budget, well, let's talk about the limited potential here. You projected a $13.6 billion deficit in Quebec. It's a lot for a province of 9 million people. S&P Global recently downgraded Quebec's credit rating from AA- to A+. Are you preparing measures to rein in spending?
Well, first of all, since the downgrade, 24-25, which was supposed to be a deficit of $11 billion, has been revised to 7.5, and that's after contributing to the Generation Fund. So the deficit of 24-25 is 0.8% of GDP. The deficit of 23-24 is 1% of GDP. The deficit of 26-27 is forecasted at 1% of GDP. So the problem is with 25-26, which is at 1.8. 1.8 is too much. BC is at 2.6. Nova Scotia at 2.2. We want to bring that down. But in there is a $2 billion contingency fund for current economic condition. So if we were not to need the contingency reserve, we'll do a lot better. So we're aware that the current deficit at 1.8% of GDP is too high. Our economic assumption, 10% tariff on average, we're currently at 8% in Quebec. Our economic forecast was 1.1% of GDP. All that is in line, so we're looking at doing better.
Was the downgrade fair then?
Sorry. The downgrade, I would have preferred a negative outlook first.
Okay. Since the downgrade, what appetite have you seen from investors for Quebec bonds and issuance?
That's how they usually do it, by the way.
Yeah.
I was a little surprised that we skipped that step.
So since the downgrade, what has been the appetite from following bond issuances?
The appetite is fantastic. We've done the largest issue in Europe, $3 billion, 10-year last summer. We're trading flat with Ontario. The demand for our product is solid. We have a credit plan to balance the budget with both expenditure and revenue measure.
Yeah, and no real changes in spreads, which is worth noting. So given the mix of geopolitical dynamic and the favorable credit environment in the US, should Canadian provinces seek to reduce or to actually increase their share of their bond issuances in US dollars?
It depends on the arbitrage. We swap everything back into Canadian dollar. We diversify our funding. Obviously, issues in euros and US are large. but we're sensitive to cost. So this year, the arbitrage was interesting. We did large issues, and we will continue to issue, on average, 2 issues in euros and 2 issues in US per year.
So no change there.
No change there.
Polls are giving the Parti québécois a win in 1 year. They're promising a referendum there. And I want to be careful with my words, but the word referendum, like, it's not necessarily well perceived in financial markets. Have investors started to talk to you about this risk that they may see on their radar?
I think there's so much risk on the radar right now that no, the focus is not on that. In due time, there will be an election. We will be competitive, and we're looking forward to win.
And just to go back to tariffs, do you believe that down the line there's...
Politics is more fun when you win.
Yes. So just when you look at tariffs right now, do you believe that bonds and the spreads and the risk is going to push the spreads higher down the line over the upcoming months?
We don't see it right now. If the tariff were to be, I want to be honest with the people that are listening to us, if the tariffs were to be permanent, there will be permanent impact on the Canadian economy to the extent that we're on a lower growth path on a permanent basis. Then we could have wider spread. We don't right now. It is in the interest of the United States and Canada to pursue this great economic integration that has brought so much benefit to both countries.
Let's talk quickly about Hydro-Quebec. So electricity was few years ago a main incentive to attract businesses in Quebec. Right now, the supply is limited. What new argument do you have in Quebec to attract foreign companies to invest in the province, considering that there's a limit on power now?
Certainly human capital. We have great universities, a lot of talent. We have a geographic location, competitive cost. We have comparative advantage, a vast amount of natural resources, expertise in aerospace, aluminum, artificial intelligence, bioscience. We have a lot of assets. We can count on ourselves.
Let's talk about human capital. So the CEO of Groupe Dynamite, it's a $6.5 billion company we have in Quebec. The CEO came out recently saying that we'll move to the US. It's headquartered in Montreal. They said that they have concerns for their C-suite executives because they actually have issues with immigration requirements. Every year, 12 months, 13 months, they have to renew their visas or the immigration requirements, which brings uncertainty. Could you provide an exemption in Quebec for C-suite level executives that have a good part of the business outside Canada?
Well, first of all, that already exists. Okay, so just to be clear, when you're in politics, there's a lot of complaints, and certainly one of my surprise, I thought a lot of citizens would complain. I found out that a lot of corporations also have complaints when you're the finance minister. 3 complaints from the CEO of Dynamite. Taxes are too high. I agree, and that's why we lowered them. We've lowered personal income tax. We've lowered school taxes, which is helping Dynamite. Second complaint, they want longer opening hours for businesses, shopping malls. We agree. We have a pilot project. When the pilot project is finished, we will extend these business. If the pilot project is successful, we will extend the business hour to all businesses. Third complaint, immigration. Population growth was too high in Canada, 2023, 2024. We need to absorb the excess. Like, for example, Quebec. We're used to 0.5 to 1% population growth. We had 2 to 2.5. It's going to take 3 to 4 to 5 years to absorb the excess of non-permanent residents that we witnessed after the pandemic. And we can do this. We will do this in a professional manner. And for special talent, like the CEO of Dynamite is referring to, we already have a program for that.
Okay, so he's not right to go out there and say that?
No. His concerns are legitimate, but there's always solution to problem. We need to sit down. He met the economy minister. I will meet him. I'm sure we can find solution, and he can continue to run a great business in Quebec.
Éric Girard, Thank you very much. Merci.
Merci beaucoup.
All right.
Please welcome to the stage Andrea Dorr, Global Head of Funding, Capital Markets and Investments, Treasury Division, World Bank, for a conversation with Bloomberg's Catherine Chiglinski.
Well, good afternoon. Hope everyone's had a good Canadian Finance Conference so far. My name's Catherine Chiglinski. I help lead the investing team here at Bloomberg News, and I'm honored to introduce Andrea Dorr, who works as Global Head of Funding at the World Bank. And it was interesting in preparing, I said, the World Bank has funded a lot more than you think, more than 15,000 development projects across so many countries that I dare not even tally. Andrea, could you maybe just give us a bit of an overview of how the World Bank works and how your role really fits into it?
First of all, well, good afternoon, everyone. And I want to first thank Bloomberg and MBF for the opportunity to be back here. Great to see a full room, and I think probably a number of investors, hopefully, also in attendance. So I just want to say thank you. Like you mentioned, I head the funding team for the World Bank. And it has been, I've been at the institution for almost 2 decades. Actually, time has gone by fairly quickly. So the group that I lead, we raise funds for the bank in the international bond market. In fact, we have been a very active issuer across the market for decades now. It's the World Bank. In fact, maybe what I could probably go back and probably explain the financial model of the bank. The bank basically, shareholders have put in a certain amount of capital in the bank. In fact, if you take, for example, IBRD, the International Bank for Reconstruction and Development, which is the largest entity of the World Bank Group, shareholders have put in just over, say, $22 billion in terms of paid-in capital. There's a portion of callable capital, but $22 billion of paid-in capital. We have taken that $22 billion and go into the capital market and leverage that $22 billion to raise funds for the bank. And over the 80-year-plus history of the bank, we have raised over $1 trillion. So it's a really efficient model. So what we do, we take that funds and we on-lend it to our member countries, developing countries, and to be used for development projects. So the leverage of that $22 billion, and the goal here is for us to raise funds at the lowest possible cost. And the reason that we're able to do that is because we're a strong financial institution. We're rated AAA. We've policies in terms of risk policies, very strong risk policies. Great backing from our shareholders. So we've been able to raise funds at a lower cost and pass on that benefit to our member country. So that in terms of the financial sort of model. Example in terms of how much funds that we have raised on a yearly basis, if we take IBRD, the International Bank for Reconstruction and Development, is the largest entity, as of the World Bank Group. It provides funding to middle-income country. Last year, we raised the highest amount in the bank history, $64 billion. We expect a similar amount of funding from the institution, so we raise on average between 60 to 65 billion a year. We also raise a notable amount for IDA, the International Development Association. It's a part of the World Bank Group that provide funding to the lower income country. And so last year we raised 19 billion for that entity. So it's a very impactful institution, like you mentioned, in terms of some of the projects that we finance globally, the largest source of development finance and expertise for developing countries, and the bank in terms of the impactful sort of investment.
Yeah, and I was going to say you have a great vantage point looking at all sort of investors and appetite for these types of deals. You know, earlier this year, the World Bank issued a USD bond with its largest ever 10-year order book, and even re-entered the Canadian dollar bond market for the first time since January 2024. So could you talk a little bit about investor demand for these offerings and your approach when it comes to entering the USD bond market or the Canadian dollar one?
Maybe I'll start with Canadian dollars, since it's a Canadian dollar conference and we have many Canadian investors in the room. We have been very active in the Canadian market. In fact, we have done, since our first transaction a couple of decades ago, we have raised over $10 billion in the Canadian market. It's a market that we have a great relationship with many investors in that market. We try to take a very strategic approach to that market and try to be present in the market at least on a yearly basis. The product we provide is driven, obviously, by investors' demand. We try to make sure that we're in constant dialogue with investors. We're to be able to calibrate the demand in terms of the funding requirements with investor demand. We have been able to issue across many maturities. The most common or popular one in terms of demand has been the 5-year part of the curve. Last year, it was probably the longest. We're consistently, like I said, in the market, but the last 18 months prior to getting back in the market in August, we were out of the Canadian market. And the reason it wasn't because of a lack of demand and a lack of commitment from the World Bank in terms of Canadian investors. It was simply due to the fact that the cross-currency swap. Our balance sheet, C5RD, is in US dollars. So when we issue in the Canadian dollars, we need to swap it back into US dollars. So unfortunately, we need to take into consideration the cross-currency. And we also have a fiduciary responsibility to raise funds, as I say, at the lowest possible cost, because we're passing on that benefit to the developing countries. So we need to compare the cost of funding in any currency, not just Canadian dollars, to see US dollars, to euros, and some of the big markets that we also issue into, and to be able to get the lowest cost. And that's the reason why we were thrilled when the cross-currency realigned a couple of months ago, that we were able to come back to the Canadian market and issue a $1.5 billion transaction. And the reception was great, and we want to thank all the investors that participated in the transaction and those of you that may potentially be in the room. It was a fantastic transaction, and we hope we'll be able to come back to the market fairly soon again. I didn't mention in terms of, you did mention in terms of the US dollars. US dollars is the largest source of funding for us. It's the deepest market. At least 2/3 of our funding come from the US dollar market. Our goal is to diversify our funding source globally. And we have investors, and we issue not just in US and Canadian dollars, we issue on average within 20 plus currencies a year. But the US market is the deepest market for us. You mentioned that we did a very successful 10-year transaction. It's, in terms of duration, 10-year is a significant trade, a $5 billion trade in the US dollar market. We try to create a curve across all currency in terms of depth, in terms of liquidity, to provide investors liquidity in that market. We work with NBF, and I think in one of our largest transactions earlier this year, in dollars as well. So dollars, euros, Canadian dollars, the goal is to diversify our funding source, get the lowest possible cost so that we could pass that benefit to our developing countries to be able to fund those development projects.
Which makes a ton of sense, and that's a large number of currencies, which leads me to my next question is, it's a geopolitically tricky world right now, and could you talk a little bit as the head of funding, like how do you evaluate, what markets you're going to tap, given this context that maybe, relations between different nations are more strained than they have been, and how does that sort of factor into your thinking about how we're going to fund our projects?
Yeah, in terms of how we fund the bank with the geopolitical backdrop, what we have observed is an increase in volatility in the market. But I guess everything is relative. Volatility, market disruption, that's relative. But it hasn't impacted our ability to access the market. As I mentioned earlier, we funded the highest amount in the bank history, $64 billion this year. So it has not impacted. What it has impacted is the way in which we approach the market. We got to be quick. We got to be very agile, because windows open and close very quickly. We're not the only issuer in the market. If we see a good window, sure, my colleagues, whether it's in Europe or my other colleagues in other institutions I expect would see a good window. So our ability to come in and go out fairly quickly is becoming increasingly important. So like I said, we have fewer issuance windows, and we need to be able to fund, and we want to be able to fund at the lowest possible cost. So whilst, like you said, the geopolitical backdrop, and we have gone through many cycles. We have gone through many cycles, and each of them is different in one way, and in some cases, they're the same. So it has been, for us, has not impacted our ability to really fund the bank.
That makes a ton of sense. Could you talk a little bit about, you guys have kind of a range of financing mechanisms, different types of bonds. Could you talk about investor preference for the types of bonds and how you've sort of varied them over the years and kind of innovated within different structures?
We have been in the market, and I've been in the market, like I mentioned, for a couple of decades. And I have seen an evolution in investor preferences. When I started, I remember investors focus, and they're still focused on return. It's important. But we're seeing the advent of impact investing. We've seen more investors, I've mentioned that in the past, focus on impact. And we have been able to respond to the changes in investors' preferences and investor demand. And for example, we issued the first green bond, and that was in response to investors' demand. We have seen then investors that are concerned about climate risk and wanted to invest in climate-friendly projects. We, subsequent to that, have issued what we call more broader sustainable development bonds, which not only focus on green, but also focus on social. We are a big social institution. And so we have also transitioned as well, more recently you'd see in the last couple of years, with what we call outcome bonds. Mm-hmm. And outcome bonds is basically bonds where the return is linked to the performance or measurable performance in terms of a project. We have one example was the Amazon link bond. So basically investor investing in this bond where the return, part of the return was used to finance the reforestation of reforestation in the Amazon. So basically what it means, it was the largest outcome bond, 225 million. 46 million of that, so investor give a portion of that coupon, was used directly for that project. So investors take directly that project risk, and investors could directly measure in terms of the actual impact of the investment. In return, the carbon from that project, if materialized, is monetized, and investors in exchange will get a portion of that funds back. So we have done, I think that was the largest outcome bond project that we've done, and we have done, I guess, 5 so far, almost.
That kind of leads me to a big question. Like, obviously, you guys have different structures, but you also focus a lot on the impact and the outcome of what happens with your different projects. Could you maybe tell us a little bit about how you guys measure success? Like, what is a really successful, bond raise and project that you sort of align together?
You see, any project that we fund in the development world is fund to achieve positive impact. The main goal of the bank is to reduce extreme poverty and boost shared prosperity on a livable planet. We have a big focus now on job because we believe this is important in order to be able creating jobs. It's important to able to address the issue of poverty, because in fact it is estimated that in the next decade there'll be over 1 billion people looking for jobs. So that has been a big focus here. So helping countries, both in terms of the infrastructure, whether on the capital side or on the human side, whether in terms of fixed roads, healthcare, access to energy, education, because that's important. Also supporting policies to ensure or to build a private sector friendly environment to be able to mobilize more private sector funding into the country. So a big focus on jobs, and we believe that is important. There's also a big focus in terms of really trying to calibrate the bank balance sheet to be able to do more. You know, like I mentioned, there's 1 billion people, you know, that will be in the workforce. The private sector funds cannot do it alone. We need to be able to crowd in private sector funding. So working with other MDBs as well, working with the private sector to be able to mobilize more funding. So we actually, to be able to really be able to create impact at scale. So that has been the focus. So creating jobs is a big, big focus of the institution, and it's important in terms of elimination of poverty.
Yeah, that makes a ton of sense. Thank you guys so much, Andrea Dole. We appreciate you so much.
I really want to thank all the investors that have continued to support this, the World Bank mandate. So thank you very much, and I look forward to, we'll continue to be in the market, and I look forward to your continued support. I always say I sell 2 things, World Bank bonds, and hopefully I'm good at it, and if not, I also sell St. Lucia. Thank you, that's where I'm from.
Thank you. Thanks so much.
Please welcome Sam Myers, Executive Director of the Debt Management Branch for the Ministry of Finance in the province of British Columbia, and Nicoletta Oprea, Assistant Deputy Minister of the Treasury Division in the province of Manitoba, for a conversation with Bloomberg's Derek DeCluet.
Thank you, Sam, for joining us. Thank you, Nicoletta. Here in New York, we're going on a trip out west now to Manitoba and British Columbia, and let's start with the trade environment and the economic environment, and talk about what are the things that the governments of Manitoba and BC are doing to strengthen their competitiveness in this moment. And Sam, we'll start with you.
Thank you very much, Derek. I'm happy to participate virtually here, and I'm very sorry that I wasn't able to attend this year in person. Certainly, in relation to trade, it's a critically important item for the province of British Columbia. Diversification is going to be of paramount importance. We're very fortunate. A very modest percentage of our exports are going to the United States. So we've long enjoyed solid trading relationships with Asia, China, but there's efforts now that the government is undertaking to expand upon the trade and diversification to other areas in Asia, such as South Korea, Japan. And this is also going to be accomplished through the feet on the ground and trade offices that we have in the various continents. And so with the focus on that, I think we're positioned well to continue to grow the economy over the medium and the long term.
Nicoletta.
Yep, thank you for having us here, and thank you to National and Bloomberg for organizing this conference. Just picking up on Sam's point on diversification, trade corridors, Manitoba from a geographic location, we're in the heart of North America. So we have access to markets in Canada, coast to coast, US and Mexico. So from a logistics distribution perspective, this is an asset for us. And a key asset is Centraport Canada. This is the largest inland trimodal port that has integrated rail, road, and air transportations, which allows for from a supply chain operations, makes Manitoba very, very competitive. And then there is the port of Churchill. Like, we're talking about diversifying trade partners and trade corridors. The Port of Churchill is the only deep water Arctic port with access to the Canadian National Railway. And it's also the only port in close proximity to Europe. So the port is seen as a strategic asset for Manitoba, but it's also been recognized by Prime Minister Carney as a strategic asset for Canada as a whole when it comes to trade diversification.
It seems like a good moment to talk, I guess, more broadly about infrastructure. You mentioned a couple of really important points that make Manitoba's economy actually one of the most resilient economies in Canada. I think, you know, relatively stable. What are some of the and there's tons of talk, as we've heard earlier today, out of Ottawa about the need to invest in infrastructure. What are the Manitoba government's priorities? How do they sort of lay out over the next number of years in terms of infrastructure investment?
Yeah, so the theme for this year budget was Building One Manitoba. And the centerpiece of the budget is a $3.7 billion strategic infrastructure plan. This is the largest investment, capital investments in Manitoba. And the focus is on growing the economy, improving healthcare in Manitoba, education, housing. There's some investments when it comes to Manitoba Hydro. So I talked about the Port of Churchill Centre Port included in that infrastructure budget or investments related to infrastructure is investments and Centreport and investments in the Port of Churchill. There's investments that are allocated towards stabilizing the rail line that goes all the way to the Port of Churchill. Investments in building the roads and bridges and building a airport up north. When it comes to building healthcare, there's plans to open an emergency room in South Winnipeg, building personal care homes, and also focus on education and building schools.
Sam, there's also an aggressive building plan, I think, in BC. Tell us a little bit more about some of the highlights.
Yes, happy to. Similar to Manitoba and virtually all of the other provinces, there's going to be a very important focus on build out of capital plans for the usual areas. Healthcare is certainly one of the largest items in our budget, and that will consist of construction and enhancements to some of the hospitals, both located on the mainland in British Columbia, but also on Vancouver Island. Additionally, the build out of the transportation sector is going to be very, very important. And this isn't just sort of preventative capital maintenance projects. We were impacted a couple of years ago with a severe atmospheric river. And as a result of that, many of the certain of the highways and the rail links were out of service for some time. So it's taking proactive actions to build upon and enhance the corridor for transportation. Housing and student housing, as an example, with the universities and college, will also be a priority for the government. And there's been great progress that's been made both in various areas throughout the province, both on Vancouver Island and on the mainland. The partnership that British Columbia will have also with the federal government will be important as well. And this one, with the announcements of the top 5 Building Canada projects, it will be very, very critical for the province to have the supporting infrastructure and allowing us to have the ability to get products to the markets without prolonged disruptions within the supply chain or due to unexpected circumstances due to adverse weather and natural disasters.
All right, let's talk about how you guys are going to finance all this. It's obviously a different borrowing environment than the one we had when we were here at this event a year ago. It's a much steeper yield curve. How are you adjusting your financing plans as a result? Where are you seeing like the most value for your taxpayers? And we'll start that one with you, Sam.
Yes, thank you. We've certainly had very elevated borrowing requirements over the past couple of years, and as per our first quarterly update, the trend is going to be continuing. This year we have a revised borrowing number, gross borrowing requirement of just over $35 billion. And I'm very, very pleased to say that we're more than well on our way to completing this program through a combination of our strong domestic issuance program that we have in Canada. The program has been very, very successful. We usually will continue to focus on building liquid benchmark bonds with preferred terms of 10 years and 30 years. But also featuring very, very prominently this year, similar to last year, was our offshore program, where we've had tremendous success in tapping the global capital markets on very, very cost-effective terms. Just in the calendar year of 2025, for example, we've had 3 very successful US dollar global issues for 3-year terms, 5-year terms, and 10-year terms. And it's been underpinned by some very, very effective investor relations activities that we've been involved with, both in Europe and in North America. So I think going forward, we'll again look at the diversification of markets and investors in order to achieve, the greatest cost savings for the taxpayers of the province.
Nicoletta, same question to you. How's the yield curve affect your thinking, and how's your strategy evolving as an issuer?
I mean, for this year, we're planning on borrowing $5.9 billion. That's what we were forecasting at budget. We looked again at these numbers with the first quarter release. Still forecasting to borrow 5.9. That's within our range for the last few years, and what we're forecasting out for the next 3 years, which is about between $5.5 billion to $6.5 billion. I mean, the way we approach our borrowing program is that we borrow in the domestic market. We consider that our main market. Issue in 10 and 30 years, build benchmarks in those terms. For us, with the size of our borrowing program, benchmark means $2 billion to $2.5 billion that we look at building on those 2 points of the curve. We also want to remain flexible when it comes to the domestic market and have the ability to pivot, either issuing on the shorter part of the curve. We've done 5 years in the past, and that's because we responded to investor demand. We've also gone longer than 30 years in the domestic markets. Manitoba Hydro, our largest Crown corporation, has longer dated assets, so that term longer than 30 years fits their portfolio really well. We also want to set ourselves in a position where there is flexibility in terms of the markets that we access. We've borrowed as much as 30 to 40% of our borrowing in international markets. Last year was just 40%. U.S. being our primary international markets, we had a very successful 10-year, $1 billion transaction last year in the U.S. We're monitoring that market for issuance this year. Given the size of our program and how we approach international markets, and that we look at where we can find ourselves in the domestic market versus international markets, we're continually monitoring, but we want to keep our presence in the U.S. market. We also have European medium-term note program, and we've used our primary for private placement. And we're seeing significant interest and demand that's reflected to us for European private placement. But what we're working on right now is to increase that program, so gives us the opportunity to look at Euro benchmark transaction. That's something that we could look at in the future. However, given the size of our borrowing program, we won't be able to do both Euro and US at the same time. So we may look at alternating between those currencies. We also are monitoring the Australian market, similar to the other provinces. We had a very successful 600 million Aussie transaction last year. We'll continue to monitor those markets and look at opportunity. And international markets allows us to complement the domestic market, to take pressure off the domestic issuance and reduce the frequency to which we go to the domestic market, and it does help with our cost of funding.
Sam, do you want to speak also as well about how you see the foreign currency issuance strategy evolving for BC?
Yes, and I would also echo just some of the latter points that Nicoletta just mentioned with regards to the benefits that an effective offshore program has had, both when we've returned to the domestic markets and creating some pricing tension in relation to subsequent competitively priced domestic bonds. But in relation to other market opportunities in foreign currencies, we've had a long-standing approach. We would be very diligent in making decisions on the timing of our offshore issuance and looking to obtain a positive, like an arbitrage opportunity. So to be able to issue at a particular term at a lower level after taking into consideration the all-in hedging costs for the deal. We've had success also this year in the euro markets. It's been we've broken new ground on 2 occasions with a successful 15-year euro deal, and just recently at the end of September, a 20-year euro deal. And those ones had a very, very high quality investor book with the great orders that came in from asset managers, pensions, insurance companies, central banks, official institutions, and build out of the of benchmarks within those in between, but very, very key terms, I think is very, very useful rather than sort of the reliance upon shorter terms of 5 years and 10 years. Similar to Manitoba, we've also had success in the past with smaller sized euro offerings that were done on a private placement basis. However, we much prefer to have those large orders where you have 1 or 2 investors coming into a public format, and we have been able to move some of the long-standing investors that have previously participated in privates into our public deals when we are going into the euro markets.
Nicoletta, if I can, since you mentioned the Port of Churchill, maybe I could just ask you a quick view on how you see that project evolving, sort of what the next steps are. There's never, in my memory, been so much excitement about what might happen at the Port of Churchill, at least in the national discussion. So what will happen there over the next number of years?
Yeah, I mean, there's funding allocated in the current year's budget to develop the Port of Churchill. The province is working with Arctic Gateway Group. This is owned by 29 First Nations plus Indigenous communities. And the goal with the Port of Churchill is to have it open year-round. Currently, it's open about 4 months out of the year, and it is used to ship things like grain to Europe from that port. So if the port was to be open year-round, which investments are being planned to reach that goal, what it would mean is increasing shipments. Critical minerals it's in demand right now, so that's one thing that could be shipped out of the Port of Churchill's. There's talks of province of Saskatchewan talking about shipping fertilizer, for example, to Europe out of that port. So I feel like the opportunities are endless when it comes to the Port of Churchill's. We just need to make the investments. And so Prime Minister Carney, recognized the Port of Churchill's as a project of national importance. We hope to see that develop in the near future.
And we will have to leave it there. Sam, thank you for joining us from BC. Nicoletta, thank you so much.
Thank you.
Please welcome to the stage Brandon Weening, Executive Vice President, Corporate and Capital Markets Finance for OMERS, for a conversation with Bloomberg's Chun-Zi Shu.
Good afternoon. Thank you for being here, Brendan.
Thank you, Chinza.
I guess let's start with, how do bond issuances help boost returns for OMERS investments?
Sure. Maybe I'll do a quick introduction about the OMERS pension plan. We are a member of the Maple 8. We are one of Canada's largest defined benefit pension plans. We are the exclusive pension provider for municipal employees in the province of Ontario. We have about 600,000 members who are members of the pension plan, and we invest across the globe about $140 billion worth of assets. And what we are as a debt issuer, we're in the SSA space, and we will issue at a AAA rate and compare that, use that to lower the cost of capital to invest in assets like infrastructure and real estate, private credit, and some such across the globe. And so the way it enhances our returns is exactly because of that spread. We're borrowing at a AAA rate. We're investing at our long-term return across the entire pension plan is about 7%. And so we earn that spread through the lower cost of capital.
When you decide which currency to issue debt in, are you looking at this, do you swap everything back, or do you try to match your debt with assets in the region?
Yeah, there are three things that are going to trigger us to be issuing debt. Principally, it is where are our investment teams able to find opportunities to deploy? And that is typically in the US and in Europe and in Australia. Those are the three currencies that we're focused on now as a debt issuance program, and we have assets in each of those currencies right now. So we keep it in those currencies to deploy in those currencies and to achieve the natural hedge. We'll also, of course, issue to refinance, and more we will use it as a tool, as I said before, just to keep that natural hedge, even if we don't have immediate deployment plans on that.
Are you programmatic in any of those currencies?
We are programmatic in US dollars. So the program started in 2019, and from day one, when we were meeting investors before that in 2018, our commitment was to investors that you would expect us to do a benchmark issuance in the spring of every year in US dollars, typically in the 3 to 5 year range. We have been true to that, and we continue to expect to be true to that every year US dollar benchmark. Euros will be a little bit less frequently, Australian dollars even a little bit less than that, but those will remain our core focus for the next number of years.
What will bring you back to the Canadian market? Do you have a more direct line of sight with Canadian investors?
Yeah, we've gotten that question, certainly with Canadian investors, if they're interested in something other than Canadian dollars. The truth is, as a Canadian pension plan, our contributions are in Canadian dollars. This is from the members and the employers. More than that, many of our mature cash yielding assets are paying us Canadian dollars, and so we have cash inflow that way. A lot of our existing liquidity that we have in liquid assets is also in Canadian dollars, so we don't have a natural need for additional Canadian dollars. And then if you consider the fact that we limit our leverage, today it's limited to 10% of the plan's net assets, and we don't really need the Canadian dollars from a natural hedge standpoint, it's unlikely. Things can change, but it's unlikely that Canadian dollars will make itself into the top three currencies we focus on.
What are you hearing from investors about what their priorities are at the moment, and how do you tap into that?
Yeah, I mean, even as I met with investors one-on-one this morning, uncertainty came up a lot. So I think their priority is certainty. OMERS itself cannot provide that to them. But what we can provide, of course, is that AAA rating with what we consider a very fair spread. And I think the interesting point that we've heard, is, especially in the last 6 to 9 months, is yes, we are a Canadian issuer. That is, we are Canadian domiciled with a Canadian mandate, Canadian members, and everything comes back into Canadian dollars. But distinguish our Canadianness from some of the other provinces, where the balance sheet that we've got that is backing these bonds is truly global. So about 20% of our assets are in Canada, about half of them are in the US, another 15 to 20% are in Europe, and then there's Australia and some other pockets of the globe there as well. So when we express that to investors, they find a real appreciation in that, the diversity of the balance sheet that they're getting through participating in our term note program.
As a Canadian SSA issuer who mostly raises funds in overseas markets,
yes.
How do you pick which banks to work with?
Great question. We are looking to partner with banks who are also investor focused in the way that we are. What that means is they've got a demonstrated ability in the primary market. They know where the investors are who are interested in the currency and the tenor that we're looking for. They help us from an investor relations standpoint, so they help us stay in front of investors who are familiar with us or who have met us but not yet had us approved. Or, really importantly, as the program grows, they introduce us to new investors who might not know about the Canadian pension space and our use for term notes, and we are able to explain the story and help convince them to participate in the next term note. And the third thing we look at when we're picking our banks is their secondary performance. How much are they trading the bonds that are already out there? Where are they marketing them? How are they able to explain the fair values that they've got them at? And are they moving our paper around? Because that's also a good investor focus as well, to make sure there is enough liquidity in the secondary market for any bonds that we put out there.
So you don't have any particular commitment to Canadian banks?
We do not have any particular commitment to Canadian banks, but I will say we always will look at the Canadian banks first. Nobody gets a right as of a Canadian necessarily. They have to demonstrate all of those capabilities. They have to earn that for sure. But all of the Canadian banks have demonstrated that they're able to do that. And all of the Canadian banks have been on our mandates in the past 6 years.
Great. How's demand for ESG labels changing? I think you last issued sustainable bonds in 2022.
Correct.
Will you sell again?
So we have a sustainable bond framework that we keep current. We annually report against the bonds that you mentioned that we issued in 2022. When we look in the space generally, we do see continued pockets of real investor interest in a labeled bond, sustainable, green, social, what have you. And so we're going to continue to watch that space. We're going to continue to keep our framework up to date. We as an investor continue to maintain a sustainable investing policy. And so absolutely in the future, I would say it's an intention somewhere to keep that going, but I do not have definitive plans at this point.
And are investors asking for it?
Do you know, candidly, as we've been on the road over the last 2 years, the conversation has shifted a little bit more to us as a sustainable investor and away from a specifically sustainable labeled bond. And I think that's, you could have a good conversation around the path that's gone. As I say, 2 or 3 years ago, it used to be, is the bond itself sustainable? Now it is, OMERS, who are you as a sustainable investor? I think there's a sign of maturity in that evolution of the conversation.
I see. So it's not the priorities have shifted, it's how you demonstrate your commitment.
I think it's how we demonstrate our commitment in a more fulsome sort of way. Labeling a bond is something, us as an investor is something more.
Will you issue in British pound anytime soon?
Good question. We are approved to issue in the British pound. When you go back to what I said earlier in the conversation, some of the triggers for what we issue, one of that would be deployment. And so I think it is feasible that if our real estate teams or infrastructure teams or some of our other investing teams find a very compelling opportunity in British pounds, and that our treasury team looks and says we can maybe fund this through cash on hand, but maybe we want to adopt some leverage, for sure. And personally, I mean, it's not about personally, I think it would be a lot of fun to try a pound bond issuance.
Are you talking to investors there already?
No, we go to London, and when we go to London, it's usually focused on the 3 currencies I've mentioned. Pounds haven't really come up. We've not gone to Ireland or Scotland or anywhere else that way, not yet.
You've been in Asia a lot, though.
We have been in Asia, yes. Our focus in Asia is partly Australian dollars. We did an inaugural Australian dollar issuance about a year ago, and there was good Asian participation there. And of course, US dollars continue to be a focus for Asian investors as well. So to the extent we keep going back once or twice a year, I think those 2 currencies will be at the top of mind.
You own 48% of Bruce Power.
Yep.
And last month, we saw a Bruce Power Generation Infrastructure Trust come out with a $1.5 billion issuance.
Yep.
Can you talk about, for an organization like OMERS, how do you decide whether to issue at the plan level or the company level?
I can talk about the parameters that exist around that. And so I mentioned before, we limit our top of the house leverage, also called our recourse leverage. Today, our investment risk policy limits that to 10% of the plan's net assets. Our credit rating agencies consider that when they award us the ratings that they've awarded us, et cetera. And so at the very top of the house, we're going to make sure that we're using it for those purposes of deploying into the currencies where we find investing opportunities, achieving the natural hedge, also complementing the commercial paper program that we have as well, where we have a $5 billion program that can issue across these currencies. And we'll take it out of that short-dated floating and put it onto the fixed-rate funding. And that is managed at the top of the house with our top of the house treasury team as well. The investment business units then have their mandates and their responsibilities at the asset-specific level to determine the optimal capital structure for any particular investment and determine the best way to execute that. And they're able to do things like you mentioned, that bond issuance from a few weeks ago.
So you don't have a hand, you don't have a heavy hand in that?
I personally, no. The programs are kept separate on that, yeah.
How has your hedging strategy evolved?
On the term notes, we've historically not hedged. We've historically kept them fixed and kept them in the currencies, as I said, that we raise them. A little bit more as we think about deploying, from an asset mix standpoint, OMERS is shifting more into fixed income. And as we do that, we want to make sure we're getting the best benefit of those fixed income investments through looking at the duration of the book overall. The term notes, of course, are contra to that. And so over the last few years, we have on occasion been hedging the rate exposure on the term notes to make sure that it's just the all-in spread that we're overall exposed to. That is not a rule that we do every time. That is something we decide in the moment, again, with our treasury and total portfolio management teams.
Do you work with other pension funds in terms of, when you want to enter a new market, or how much do you work together?
I would say the relationship amongst the Maple 8 in this term note issuance space is collaborative. I would say we all have our own objectives, our own programs, our own parameters, et cetera. I would say there are some who are out there leading, and there are some who are fast followers. I'd characterize OMERS broadly as a fast follower and looking and seeing and benefiting from what some of our peers have done before us. I'd say, we have good connectivity and we compare notes after any particular transaction, but I wouldn't say there's a pre-meeting of all the pension plans before we enter into a new market. That is a lot more individual.
Yeah, well, comparing notes is helpful.
Yes.
Well, I think we're super efficient.
Very good. Okay, thank you very much.
Thank you so much. Thanks, Brendan.
Please welcome to the stage Steve Berna, Managing Director of Indigenous Relations, National Bank of Canada, and Chief Evan Tepotat, Kakwishtaha First Nation, for a conversation with Bloomberg's Melissa Shin.
Well, good afternoon, everyone. Thank you so much for joining us again, and a very warm tansei to Chief Evan.
Hey, tansei na tutamak Evan Tepetat Natsiga Sun Kakwistau First Nation of Chinia. What I said in my Cree language was "Go Blue Jays, go!" Kidding. One of the things that I like to live by, and as a leader, one of the things I like to do is I have a little saying that is, if you're the smartest person in a room, you're in the wrong room. Being here today with you all, seeing all the great speakers, seeing the people in the crowd taking notes, I know that I'm in the right room because there's some awfully smart people in this room. When I was asked to be here from Steve about 6 weeks back, I thought I would come on stage and tell you about who we are as people, who the First Nation people are of Kakawistau. But I think it would be a missed opportunity if I just stood up here and talked. A picture is worth 1,000 words, so I think what I'd like to do is show you a 3-minute video just of who we are, what we're doing, and a little bit about the complexities of who the Cree people of Kakawistau are. Kakawistau First Nation is located in Treaty 4 territory, 2 hours east of Regina, Saskatchewan. We are 2,374 people strong, with 800 people living on the First Nation and another 1,600 living throughout North America. Our people are strong and proud Cree people. We have been on our First Nation since 1874, when Chief Kakawistau signed Treaty 4. Before residential school, our people thrived in this land. We knew our language, we knew our culture, and along came residential school. That effect took that from our people. To support community wellness, we have made a dedicated effort to revitalize our culture and language. Our elders programs recognize their efforts and connect them with the next generations. This is how their teachings pass on to the young ones.
We're teaching them how to provide in Indian ways of their life, how they can teach in the near future to their kids too.
Now, our school has 4 language teachers and a dedicated department to land-based knowledge. Things such as hunting, teepee making, trapping, and skinning are part of things that we teach our youth at our school. Everything we do is based on ensuring that these young ones have opportunity as adults. They are our future leaders.
We are building them, guiding them. We're working together as a team, as a community, as a village to bring that leadership from ground up.
If I was to be in leadership when I'm older, then I would know what it's like because of the opportunity I was given in high school.
Our leadership team has invested our settlements in land development across Saskatchewan and forged partnerships with industry that generate growing revenues we invest back in our community and economy. As a result, our members are staying at home and there is a long list of members wanting to return.
I see great things that are going to happen in the future and many opportunities with our education programs, our health programs, and our economic development programs.
We have scholarships for grade 12 graduates and many on-reserve training and education programs. We're building homes and infrastructure that support our community's path to sovereignty.
Thinking of our children, thinking of our children unborn, there is hope for them. There is promise. There is strong foundations here that they can build on.
Our goal is to have a self-sustaining community rich in culture, language, and opportunity.
That was indeed a 1,000 words, so thank you so much for sharing that with us. And a little bit was mentioned in the video, but for those of you who don't know the history of Canada, there have been systemic barriers to Indigenous peoples accessing capital for a long time as a result of colonialism and a failure to recognize Indigenous jurisdiction, as well as systemic discrimination. Back in 2015, the Canadian government released 94 calls to action as part of the Truth and Reconciliation Commission. To date, only 14 of those have been fully implemented, so that's been 10 years. But it was definitely a acknowledgement and recognition of the challenges and opportunities facing Indigenous peoples. And so as a result, I did want to ask you, because there are now opportunities coming, what is the size of that opportunity, Chief Evan, in terms of working with Indigenous peoples?
Thanks, Melissa. So when the TRC recommendations came out in 2015, there was 94 of them. One of the things that gave us ammo. For 151 years to date, we've never really been recognized as these people. We were just kind of put on the First Nations, taken to residential school, and essentially took the Indian out of the Indian. What the TRC recommendations did, it gave us finally acknowledgement to who we are, the systemic racism, the barriers that have put in place. And along that time, the Liberals at the time who were in power and still in power in Canada, a man by the name of Justin Trudeau, people love him or hate him, but he gave the direction to settle claims. So what I would tell a room full of very American investment type people are, in the last fiscal year, there's been $7.1 billion worth of specific claims settled in Canada. There's 674 First Nations, all of Canada, right? I visited an investment firm yesterday that has 20 clients. 20 clients have taken those settlement claims, and they now invest $1 billion. So talking to the American crowd today, I would say there's a lot of First Nations in Canada that are settling claims. There's a lot of First Nations that would say, hey, come be our partner. But we have a little word in our language, and it's W'gotuwin. And the W'gotuwin word means relationship, kinship. Okay, we're not just going to accept you into our community and say, yes, take our dollars and go put them to work for us. You're going to have to come to our communities and seek that acceptance, but it's not a hard thing because my people are very welcoming people. So I would advise the people of USA, investment people in this room, make an Indigenous swing. And in that Indigenous swing, go out and pursue some of those dollars that are in Canada. Because there's a firm, international firm in New York City that has $1 billion worth of our dollars. And they're put to work for us. Right now, my First Nation has $170 million invested. $170 million. We're building a road in Germany. We're building a hospital in Kentucky. Those are things that we are doing. It's why I wanted to show the video, because those people in the video all need to ensure that the dollars work for us, because as Josephine said in the video, we're investing our dollars for the future. We're planning essentially for 7 generations ahead, because it's taken us 7 generations to get on this stage right here and tell our story.
Yeah, that's very powerful. And you know, when you're taking those meetings and you have investors coming to you and wanting to work with you, what specifically are you looking for in a partner?
I think just genuine. On our First Nation right now, we do business with people with good hearts. If we're just a dollar sign to you, don't come knocking on our teepee, don't come knocking on our door. But if you generally want to be a partner and want to understand our people, seek us out and come and see that. Right now, we have an economic development wing right now, a board that's out there meeting right now. It's full of mayors, it's full of bankers, it's full of businessy type people. And they're just in a room right now in Saskatoon as we speak, trying to figure out ways to get it right. Because if we have $170 million invested, all those other opportunities come. We like a 7% return on our investment. We'll take 10% any day of the week as well. But right now, that group right now is trying to figure out how do we better serve all those people that you just seen in the video.
Gotcha. And Steve, you know, thinking about National Bank, what is your approach to reconciliation and working with First Nations?
Yeah, thanks, Melissa. Well, you know, when people say economic reconciliation, I bet if you went around this room, you could go back 2 or 3 years and people say, I'd never heard of it before. But anybody in Canada who studied in history, one of the first things they learned, probably in grade 8, was this thing called the British North American Act. And the BNA Act goes back to the creation of Canada, where you had the European settlers and you had Indigenous people realizing that the land was going to be occupied by both. So the Act promised in 1867 that going forward, Indigenous communities would benefit economically in the growth of Canada, have access to resources, have access to make sure their way of life was maintained and respected, and it all changed. 9 years later, 8 years later, when the Indian Act came in, it absolutely put up barriers that shut that down. So we are not doing what's new. Economic reconciliation was the dream of what Canada was meant to be. So National Bank, some people know, some people don't know, we have done sponsorships for Right to Play for children. Get them out, have fun. We've done literacy for those that are having challenges in educational system in elementary school. Get them on the right path so that learning becomes fun, not something they avoid. We have National Arts Council, Aboriginal artists supported. One of the main things that National Bank did was put a $100 million line of credit up, 2013. And that $100 million line of credit allowed Indigenous communities to borrow for the first time at rates that paralleled what provinces pay in Canada. Every other bank said no. So a lot of these things aren't well known. And we have 2 people over there, Rachel and James, who are looking after FNFA now, doing a great job. But what is needed to do economic reconciliation is more than just debt. You have to know your client. Structure your bank in such a way that when you get to know your client and the economic opportunities or their community needs and priorities come in, you can respond to those quickly, you can respond to them respectfully, and you can respond to them in a time that meets their needs. So we have structured ourselves that when we talk to communities, all departments are ready to respond. It's not a junior staff person, it's a senior staff person that's given their thoughts back. We are positioned so that when a client says, come visit us, we'll visit them. You know, there's that thing in the finance world, KYC, know your client. If you don't get to know your client, you never understand the relationship, how to build it, how to grow it, because it shouldn't just be for a project, it should be for years to come. So National Bank is very proud to be on this journey. I think we've structured ourselves in such a way that we can be a trusting partner along this economic path that's long overdue. But the one thing that I would like to say is when you consider a partnership, a lot of times you consider it contractual. You have a need, you have a person that fulfills it, You meet in the middle, you sign it, go your own ways. Different here. What you need is what's called a true partnership. And National Bank has started that in a project that I'm working on with Evan, is that if the bank provides services or its products or advisory service and get paid for that, then the Indigenous communities need to benefit also. So a true partnership is one where both sides walk away and say we're better off now than we were earlier in the day. So I'm very proud of where we are. I think we have an exciting path going forward, and I think National Bank can be a National Bank can be a financial institution that has the trust of the Indigenous communities going forward.
Okay, thank you. We have seen in Canada after the election of Prime Minister Mark Carney this push toward what we call major projects. So there's been talk about building pipelines and LNG and a port and all that kind of thing. And there was a bit of controversy over how First Nations and Indigenous peoples would be involved in these decisions. So Chief Evan, what are your thoughts on kind of how this push for major projects will affect your community?
Yeah, I think there's a misconception about our people, and they think that we're against pipelines, we're against all these. We're not. We are pro-living, we are pro-life. It just so happens for 151 years we've been left out of the conversation. There's a difference there. So we on Kaagweastal First Nation are pro-oil and gas because we are pro-sovereignty, and we want to make sure that we set ourselves up for success for going forward. In terms of the Major Projects Coalition, Canada is essentially saying to us right now, trust us First Nations people, trust us Indigenous people, we'll do right by you. And for 151 years, they haven't done right by us. So for us, we're optimistic that Prime Minister Carney and his cabinet are going to do right by us. We now have an advisory council in place. Chief Darcy Bear is on that, and my good friend Lauren Pelche from the Manitoba Métis Federation. We know they got the right people at the table. The proof will be in the pudding in about a year from now if Mark Carney is serious about economic reconciliation.
Right. And Steve, how are you seeing that show up in your practice in terms of the major projects push?
Oh, there's so much opportunity coming down. And, the Supreme Court of Canada has ruled again and again and again that if you want to do projects in Canada, start talking to the Indigenous communities, because if it goes across their territorial land, they should be consulted. They should be have discussions with them, and they should be included, whether they want the opportunity or not. And a lot of the businesses, that I talked to said, we'd love to do that, but how do we contact them? Where do we start? We have a project we'd like to do, and it goes from A to B, and there's probably a bunch of communities whose lands it goes over. How do we even start talking to them? And it's one of those areas where, sometimes a phone call to me or somebody, if you know somebody else at National Bank, we can get it going. But once you start knowing who to talk to, you'll be surprised at how quickly it develops from there. So it is unavoidable, the economic reconciliation that's coming, but it's also a huge opportunity because when you didn't have reconciliation, you had objections to certain projects, and it caused them to stall, it caused cost overruns. When you do have reconciliation, you have all sides at the table. And when you have all sides at the table, you're going to find out the budget that you have has a much better chance of getting fulfilled on time and within the cost that you want, because all sides have had input and all sides agree to the path that it's going. So I think it starts with picking up the phone, contacting somebody that maybe can put you in touch with somebody that you should be talking with, and go from there. We'd be happy to facilitate that.
Interesting. Chief Evan, when you and your community are thinking about the types of projects that you want to invest in, what are some of the criteria that you look at?
I think just like I stated earlier, just reaching out, making sure you have a good intentions, good heart. I think lost on all that is health is directly related to wealth. Health is directly related to wealth. And when my people are the poorest people in the country, we are the unhealthiest people. And that's the way Canada made it. So for us right now, it's about addressing those barriers, addressing reconciliation, and ensuring that we have the opportunity. So when people come to us and knock on our teepee and they say, hey, we want to be partners with you, we do really want to be partners. How we're different from the tribes from the States, United States, is in Canada, we got that word that Steve keeps referring to called reconciliation. We have say now. You can't just build something without us because that happened for far too long. And in turn, we're the poorest people in the land. So right now, we're trying to address that. We want to ensure that we live those long, meaningful, good lives that you want to live. Your anniversaries, your weddings, your graduations, those are just as important to our people. And so that's why we're sitting in rooms right now in Saskatoon. That's why we're at meetings with Steve Burness. That's why we're at meetings with oil and gas, because we want to make sure we get the dollars from royalties. We want to make sure we get the procurement, because the jobs create money, money creates opportunity, opportunity creates breaking that cycle that residential school has put on my people. So that's what we talk about a little bit when we want to be included.
Could I add something, Melissa, please? So, you know, if anybody's sitting here, and I don't know how many people or investors in the room that buy municipal bonds, or you buy state bonds or provincial bonds, and you know, you take a look at the politicians that are at the municipal or state or provincial level, and you'll say, they govern. So how do you have a chief up here that's talking about business? Well, if you get to know an Indigenous community and you get to know their leadership has functions that overflow what you would call a regular politician. It is not uncommon in Canada for you to get funding that doesn't fully cover your educational costs, your health costs, your administrative costs, your social costs. He's responsible for making up the difference. The cents on the dollar that are missing from the federal funding in Canada, where does it come from? It falls upon leadership to look for business opportunities. So when you look at a Canadian First Nation and Canadian Indigenous community, think of them as part business. They need to be. But also on the governance side too, speaking for their people. So it is a bit of a different scenario than if you're just looking at what a state, province, or city does. You've got a business component here, which means the door is open, as Chief Evans said, if it's something that meets their requirements or their vision for their community.
And based on your experience, Steve, what needs or additional future investments do you foresee for Indigenous peoples generally as they come to your practice?
Well, they're all individual nations, and they all have their individual approach. I would say, minute 22 seconds left. Can I ask Chief Evan to answer that, what it means to his community, please?
Yeah, thank you for that, Steve. As you saw in the video, a lot of my First Nation members are in there. You've seen Kukumvesta in there. Kukumvesta was the lady in the red zip-up. She's lived a really hard, horrible, long life. And she got through all of that residential school. She got through all of the bullshit that Canada has thrown at us. So it's my job to be here on stage to ensure that she at home right now, what she did and what she went through is all for naught. It's our job as leadership. It's our job as chief and council. It's our job as the economic development team that's watching at home right now. It's our job to make sure that it's better. It's also our job to ensure that history doesn't repeat itself. Reconciliation is a word we throw around in Canada all the time. Everybody, every business does it. Every investment firm, every oil and gas, they throw it around like it's going out of style. Reconciliation has to become reconciliation. And it can never be reconcili-rhetoric, because we will never repeat history. I will not let the people that are in that video be let down, because we owe it to them. In this room, we all owe it to them. We owe it to the original people of this land to help them be sovereign and help them live and help them strive. So.
Well, I want to say Kinanasko Mitin, which I think means thank you in Cree, and to all of you for your attention.
She just said go Jays, go
I did say go Jays.
What she said,
I did.
She said thank you in Cree. Kinanasko Mitin means thank you in Cree.
All right, and appreciate to all of you. Thank you, Steve, as well.
Yeah, thank you.
Thanks, Steve.
Please welcome to the stage Manrup Jahuti, Senior Managing Director of Total Fund Management for CPP Investments, for a conversation with Bloomberg's Amanda Cantrell.
Thank you all for joining us. As you've just heard, I'm Amanda Cantrell. I help run the U.S. investing team here at Bloomberg. And I'm here with Manrup Jahuti, the Senior Managing Director and Head of Total Fund Management for CPP Investments. Manrup, thank you so much for being here today.
Thank you very much for having me. It's my second year here, so fantastic to be back.
Great, welcome back. Well, we don't have a lot of time, so let's get right to it. I would first love it if you could tell us a bit about CPP and then your role within it and what Total Fund Management encompasses.
Sure. So CPP, for those who don't know, or CPP Investments in particular, manages roughly $730 billion of assets on behalf of the CPP and the 22 million beneficiaries and contributors within Canada. Within the CPP, total fund management really has three main kind of pillars to its mandate. So I'll quickly go through those. The first is we're responsible for the portfolio design. So we do, in essence, all the research, the analytics, and the modeling that goes into all of our asset allocation decisions. So the decisions that are the backbone of our geography choices, our asset choices, all come from within TFM. The second piece of what we do is what we call the portfolio management piece. And really what that's intended to do is it's intended to ensure that once we've set those design targets, the total fund is actually getting as close as it can to those targets. So a lot of our investing teams will invest where they find the best opportunities, where they think they're going to get the best risk-adjusted returns. It's TFM's job to then take that bottom-up investing, compare it to those targets, and ensure that we are getting as close to those optimal design targets as we can. And then the last piece of what we do is what we call portfolio implementation, which really is around sort of ensuring the balance sheet is being managed prudently. We have the appropriate liquidity on balance sheet. We're managing all of the financing activities on behalf of the top of the house. And then we also do all the trading on behalf of the fund as well.
Right. So I know that you all are long-term investors, but I would like to talk about the short term for the time being. There's a ton to navigate right now between tariffs, geopolitical risks, the U.S. fiscal situation. How are you, with that in mind, how are you positioning the portfolio now to take advantage of any of the dislocations and also avoid some of the pitfalls?
Sure. So, one of the things that we always kind of remind ourselves, but frankly, when we talk about the portfolio, remind others, is that we are a long-term investor. Our objective is to maximize returns on behalf of the CPP over the long term to ensure plan sustainability. That's first and foremost our investing philosophy. What that means is that when we design the portfolio at the outset, we're really trying to design a portfolio that is able to withstand multiple types of economic shocks and is able to be resilient through multiple cycles. It's not about setting up a portfolio that we think is going to be the best portfolio for the next 12 months. It's really about setting up that portfolio that we think is going to maximize returns over the long run. Now, when it comes to the current investing context, it doesn't mean we don't take into account what's happening in the market. We certainly take into account what we're learning and what we're seeing, but we tend to view it through the lens of what is the impact over the medium to long term as opposed to what do we think tactically is happening. A lot of the tactical things that happen in the portfolio, frankly, happen within our investing teams, the ones that are out there looking for investments in private equity or credit or in real assets, where they're really seeing the day-to-day opportunities from a bottom-up security selection perspective. From the top-down perspective, we're really more concerned about what are we seeing in the market today that perhaps changes some of our long-term views of what we think is, sort of the equilibrium between asset classes, between FX, between various risk factors. And so that's philosophically kind of how we generally view the world. When we're thinking about the current context, to actually get to your question now that I provided a big preamble, when we think about the current context, there's probably a few themes that are on our mind. That's probably an easier way to kind of tackle it because there's many things that are frankly happening. I think the first is AI, by no surprise. We are thinking about AI both in terms of the immediate investing opportunity, and that's not just thinking about sort of the specific things around the Mag 7, but it's really things that are adjacent to AI as well as those things that are explicitly AI, whether that's power or energy, infrastructure and data centers. Those are certainly an aspect of the market that we think provides significant opportunity, and you're already frankly seeing it in terms of the degree of CapEx that's going into the AI space generally. We are also thinking about the implications of the world moving away from globalism, multilateralism to something that looks closer to bilateral transactional relationships between trading partners, and what that means not just for supply chains, but what it means in terms of trading blocks and where the opportunities are going to be, what the opportunities are as economies begin to sort of champion domestic champions, think about reshoring or friendshoring. What does that mean in terms of the risks and opportunities that come? And then the last piece of the kind of the core theme that we're thinking about is generally things around, let's call it the fiscal umbrella. And really, there's a few threads to it. Really, it comes down to longer term, how do we think about what's happening vis-a-vis fiscal deficits that are happening not just in the US, across the globe, and what does that mean for kind of our traditional views of assets, in particular, our traditional views of the role of fixed income in portfolios that has typically been a very important diversifier when you're constructing a portfolio. And do we think those same diversification benefits that we've seen in the empirical data will hold up in light of some of the fiscal challenges that we see?
Right. So what are some specific opportunities within those broad themes you mentioned, like AI and deglobalization, that you think are most attractive right now?
Yeah, I think I think AI on the one hand, I think it's to some extent it's really, there's a really interesting opportunity set around the adjacencies. I think there are constraints and limitations as it relates to power and energy that's going to be needed to continue to support the AI build-out. The data centers themselves and the requirements for chips, I think, do create interesting investment opportunities that we haven't seen, at least in the more recent past. So that's one piece. On the fiscal side, I kind of referred to it more from a medium-term lens, but there is a short-term lens to the fiscal, which is between fiscal and the move towards, let's just call it more bilateralism, perhaps reshoring and friendshoring. There is a new impetus for fiscal to be used in nation building, and I think that creates a really, really interesting opportunity. You're seeing it in Europe. You saw Germany for the first time actually talk about running fiscal deficits to help support infrastructure, to help support defense. And we think those are really, really interesting opportunities for a fund like us that likes to deploy capital into infrastructure-like projects.
Right. And, I'm going to ask as a follow-up the flip side. What's making you nervous right now? Or at least what are you sort of avoiding for the time being or being cautious about?
Yeah, I don't think there's anything that jumps out that we're avoiding in this market. And what I really mean by that is there's nothing, obviously, where we think that there's excessive risk in the market. We are, in all these things, being cognizant of the overall macro backdrop. So in one sense, you have a great degree of tailwinds as it relates to the CapEx and investment that's happening vis-a-vis AI, as well as the fiscal stimulus that we've been talking about. But you kind of have to look at the flip side of the macro equation, which is some of the headwinds that we see. And so we're starting to see some of the headwinds around sort of weakening labor markets, perhaps a bifurcation of the U.S. consumer, as an example, where upwards of 50% of consumer spending is actually being done by the top 10% of the consumer. And so you have, at the same time, you have these tailwinds. There are headwinds, and you need to be mindful of those headwinds because it's not just in many cases it's really a balance between do you think it's the tailwinds or the headwinds that are ultimately going to dominate the investing landscape, and that's really the approach we're taking as opposed to staying away from particular markets or assets.
Great. And shifting gears a little bit, we talk a lot about private market investing here at Bloomberg. You do a lot of both public and private market investing. How do you decide which approach to take for a given asset class, and how do you sort of adjust and rebalance when, say, the returns for public markets in one asset class appear to outstrip private and vice versa?
Yeah, so when it comes to the design aspects of it, what we really try to balance between being public versus private is ensuring that we have enough liquidity on balance sheet, not just to meet liquidity needs, but to have enough liquidity on balance sheet to be able to move to where the opportunities are, to be able to rebalance your portfolio, and ultimately be agile in a market that provides risks and opportunities on an ongoing basis. And that balance is really trying to find that right level of public market investments to create that agility while still ensuring we are deploying into the private assets that we think, at least from our own track record, have significant excess returns across private equity, credit, and real assets, that we want to ensure that we're deploying the right amount of capital to continue to generate those alpha and excess spread opportunities. But it's really about finding that balance from a top-down asset allocation standpoint. When we think about what's happening day to day, it really comes down to a question of how do you assess relative value. And it's an area that we spend a lot of time on in terms of assessing private transactions versus what we think the public market alternative is, so that we're always challenging ourselves, not just thinking about what's the headline IRR of a specific transaction, but trying to decompose that IRR to what do we think is, how much of that is systematic, how much of that is true security selection and alpha, and how does that compare to what we can do in public markets, which provide a greater degree of liquidity. And it's that relative value discussion that I think becomes critical. And it's fundamental to how we think about investing, where it's not just you have X amount of capital, go and deploy it. It's really about where is that capital ultimately best deployed. And having that relative value lens is important to think about the day-to-day trade-off of what you do in public versus private markets.
Right. I'd like to drill down a little bit on private equity. We've been writing a lot about the difficulty that some private equity firms have had. Well, a lot of them have had selling their portfolio companies, getting distributions back to investors. We noticed that you all reduced your private equity exposure slightly in the last fiscal year to 21% from 25%. How are you all thinking about private equity now?
So we're very comfortable with our private equity allocation where it is, around 21, 22%. The reduction that you were referred to, I think, is perhaps a little bit of a construct of what I'll describe as market dynamics. I think coming out of COVID, opportunities to dispose of assets through traditional channels, whether it be IPOs or sales to strategic or what have you, were limited for generally the private equity universe. We're starting to see some of that turn back on. And so you saw a natural growth of private equity in the portfolio as a percent of the portfolio being more reflective of market dynamics than anything else. It's not us reducing from 25 to 22 because of a view on private equity. It's frankly a consequence of what we're seeing from a market standpoint. But we do think where we are at 21, 22% is appropriate.
And we talked about public versus private. I'd like to ask a similar question in terms of direct versus indirect. How do you decide when to outsource and when to invest in-house?
Yeah, when it comes to direct, we have to continue to believe that when we go direct, we are doing so because we believe we have some form of edge. If we don't believe we have edge, we shouldn't really be going direct. But what's really important about that direct indirect is that even when we go direct, going direct doesn't mean you go alone. And in many instances, we're working very closely with our partners across capital markets, in particular our GP partners in the private equity and real asset space. We're partnering with them to find those opportunities and working closely with them to originate transactions, structure transactions, and ultimately execute. But the beginning principle is that we go direct in asset classes and strategies where we genuinely believe we have edge.
Okay. Well, I think I have time to ask you one more question. So I feel like this being the Canadian Finance Conference, I'd be remiss if I didn't ask you how you're thinking about investing in Canada.
So we are very bullish about investing in Canada. The backdrop is one in which we're starting to see strong momentum and a galvanization of political will to kind of consider major projects and nation building in a way that we hadn't seen before, and we're genuinely excited about the opportunities that presents, particularly for an investor like CPP, and we're bullish about that prospect. We're interested and engaged in those discussions, and so we're very excited about the prospects. We have a significant portfolio in Canada, and we'd love to be able to add to it.
Great. Well, I think that pretty much leaves us with not enough time to ask another question. So really appreciate you taking the time to be here. And thanks very much.
Great. Thanks very much, Amanda. Thank you. Thanks.
Please welcome to the stage Stephen Thompson, Assistant Deputy Minister, Treasury and Risk Management, Province of Alberta, and Elizabeth Wallace, Senior Manager, Funding Capital Markets Division of the Ontario Financing Authority, for a conversation with Bloomberg's Eric Hertzberg.
Well, Elizabeth, Stephen, thanks for joining us. It's good to be in New York. we're in New York, so let's start off with talking about foreign demand for your issuance right now. We're seeing non-Canadian trading of provincial debt rising steadily since 2023. Let's talk generally about why that is, and in current months, maybe talk about whether the outflows potentially from U.S. Treasuries is having a little impact on.
Okay, I guess
Please, ladies first.
I'll get things started. In terms of borrowing non-Canadian interest in the Canadian sector of issuers, we do have something we're colloquially calling Canada Inc. Not something we coined, something that has sort of emerged as we've gone through since 2023 with international interest in Canadian credits, specifically the Canadian provinces and PSC credits. You just had one sitting here just before us. And our presence in those international markets, our reach into them, is somewhat buoyed by all of us participating. So for each one of us that goes into a market outside of the Canadian dollar, what we're finding is it kind of paves the way for the next and the next. And a lot of receptivity. I think foundational to that receptivity is the fact that Canada on the world stage is having a bit of a moment in that we are a politically and economically stable space in a world that has many sort of unsettled regions or just periods where things seem to be, I guess, somewhat volatile and hard to get a read on. So I think that backdrop has been really constructive. And when you look at something like what I'm calling Canada Inc. here, you're looking at a variety of credits that are all extremely credit worthy, but still give you a little bit of room to play up and down the credit curve, and also give you slightly different personalities for each of us, which I think over the course of the last day and a half, we've been meeting with investors, as have many of the Canadian provinces and pension funds here. And we've all been telling our unique stories, but underlying that is a common thread that binds us all. And we are really having, like I said, that Canadian moment on the world stage. And I think we're all supporting each other as we go out into that world and try and raise funds for our different programs. And that's really kind of resonating with investors in the here and now.
Yeah, no, I would agree. I think the personalities comment might have been directed at me, but that's okay. As Canada, as issuers, Canadian provinces are really quite unique on the world stage. We have far more autonomy than you see in sub-sovereign issuers generally. But we also have great liquidity. The Canadian domestic market is the foundation of what we've sort of taken to the world. And we've all been quite regimented. We've all been quite programmatic, systematic about how we approach the Canadian market. And we've ensured that the Canadian investor base is well informed, is able to trade in and out of our bonds. As Elizabeth says, has a menu of options. You have Ontario, which is sort of the base of the Canadian provincial issuance market, and then you can trade in and out of more wild credits like Alberta. You can get a little more spread, a little more volatility. But as we take that into the world stage, it's interesting that we see, our first entry is always sort of in foreign currency, meeting foreign demand, but then maintaining that same level of liquidity, that same level of interaction with the investors. And as Elizabeth said, like the development of Canada Inc., which involves, frankly, the pension funds spending a lot of money, which as provinces we don't or can't, in the same way in terms of marketing, in terms of global presence, in terms of also partnering on investment, not just on issuance. We've actually banded together, like, we're Canadian, we're not Albertan or Ontarian. We all work together.
So we talked about some of the similarities that you guys work together on. Let's talk about some of the differences, and in particularly some of the headwinds that may be coming up or are currently here for your different economies. I'll start with you, Elizabeth. Ontario, dynamic, diverse economy, but also quite trade sensitive. And there's sectoral tariffs that are on some of the products, main exports of Ontario, and the outlook for growth is around 1% to 1.5%, I think, over the horizon. Tell me about some of the challenges, or maybe some of what you're hearing from investors regarding some of the headwinds facing the Ontario economy.
I would say that in terms of the feedback we're getting from investors at this point in time, we're Canadian investors especially, but now more as we are more prevalent in foreign markets, it's coming through there too. There's a little bit of differentiation where there's time being spent understanding each province rather than grouping it as like all of us being very similar. So one of the messages that we're strongly delivering here is that we do have a diversified economy, that more than 3/4 of our economy is based on services. Only 23% is goods. So when we talk about trade impacts, we're scaling from there, and then 10% is actually manufacturing. So yes, we're concerned about the impacts of what is happening in the trade space and the uncertainty and unsettledness of that space right here, right now. But there are other things going on in the Ontario economy because of its diverse nature that somewhat help buffer, et cetera, what is going on there. I would say that unsettled nature of what is happening in that space does have implications in terms of individuals delaying decisions on terms of their sort of spending and consumer behavior, but also businesses, their spending and investment in their business. And so that delaying of decision making, we're seeing that come through in the numbers that we're expecting to see for 2025 and into 2026, after which we should have a clearer picture of what we're facing. We're a big and diverse province, and so what we are seeing in the shorter term is that there has been signs of resilience and adaptation to this sort of uncertain backdrop where adjustments are being made. We do have 77% of our exports going to the U.S., so that is an exposure. But we also have 52% of our imports coming from the U.S. So there's a little bit of a natural hedge in that relationship. I'm not going to pretend that it's equal and offsetting, but so there's discussions to be had, and obviously as those evolve, Ontario's economy will evolve with it.
Steve, maybe you want to pick this up. On the Alberta side of things, in the Alberta economy, there's always been some sort of exemption that existed for energy products, and that's given you some sort of immunization from what's going on for now, at least at this point. Maybe talk about some of the headwinds that you see and how it's affected issuance for you in the last little while.
No, for sure. And we're sort of the polar opposite of Ontario. Alberta is a concentrated economy. It's concentrated in the energy sector. It's not that the other sectors of the economy don't exist. We have a large agricultural sector, we have tourism, we have trade, we have manufacturing, but none of it can compete with the scale and the scope of energy. A full 20% directly is mining and oil extraction, but I would say a full third of the economy is heavily linked to the energy sector. So that makes us a very volatile, it makes our revenue stream very volatile for one, but also makes our economic fortunes very volatile, heavily linked to the United States, obviously. I haven't updated the number recently, but it's somewhere around 95% of our energy exports go to the U.S. And so when we budgeted for the coming fiscal year in February, we were sort of peak tariff rhetoric. We weren't sure what to expect. We were told 25%. It turns out all of the energy exports that we're really concerned about are USMCA compliant or needed some paperwork filed. So we haven't seen any drop in demand for our product, and any increase in price that resulted from tariffs, which have not been really placed on the energy exports, would have been borne by the U.S. consumer, the U.S. refiner. So our fortunes are more tied to the trade in global energy. So there's a far larger impact on provincial revenues from WTI. So West Texas Intermediate is one of the inputs into our royalty regime. It's what the tax system is based on when we tax oil coming out of the ground. And so $1 change in WTI over the course of the year amounts to a $750 billion change in the Alberta revenue picture. And that's like the full 1% of the budget, and that's just $1. And we've seen massive swings. Right. So from our perspective, it's a matter of, when we're talking about funding, just being far enough ahead of things that we don't have to fund as needed. But at the moment, we're very cash rich, so we're always well ahead of the program. But it's a matter of explaining to investors that volatility isn't necessarily weakness. I mean, it can lead to periods where we're running massive surpluses. So for the past 5 years, the provincial budget's been in a surplus position. And this is a very fiscally conservative government that's in power at the moment. So they've actually used it for debt repayment. You know, we're the first province in Canada in decades to actually be paying down debt. And then we're also investing into the Heritage Fund, which is our sovereign wealth fund. So the uses of our cash are a little different depending on where our fiscal situation is. So we're in deficit right now. That means that we'll be borrowing more. But our balance sheet looks very strong at the moment, very much different than the other provinces for sure.
Right. And so in terms of issuance right now, you're expecting over 50 and you're on?
We're like 12 and a half.
You're 12 and a half, right.
We're not expecting over 50, no.
No?
Oh, dear.
Our current number is $42.8 billion for this current fiscal year. And then if there's an opportunity, we may or may not do some further borrowing. Last year, we finished our borrowing program in the first week of January. And so had almost 3 months of additional time to do borrowing, what we would call pre-borrowing, pre-funding, whatever term you like to use for that. And I anticipate that we've just finished the halfway mark of our fiscal year, and we're 74% funded on that $42.8 billion. So anticipate that we may look at a similar scenario where we're completed our set borrowing program in early January and have the following sort of 2.5 or so months to do other borrowing if we choose and if the market is receptive.
Okay, great. So let's talk. We're going quick, which is so it always goes quick.
Time flies.
But let's talk more about some of the other trends we're seeing here. So in sovereign nations, there's a lot more debt being issued in general, and maybe talk about also what's going on in terms of the steepening we're seeing in the curve, how that affects your respective strategies.
If I may.
You go first.
Sure. We're relatively agnostic on the curve. And look, we're a constant funder in the markets. You know, you look at our maturity profile, we've always got a stack of a few billion ahead of us. So if we start to pick and choose our points on the curves when it comes to issuance, it's gamesmanship that doesn't really amount to long-term cost savings for us. We're always going to be funding ourselves in the market. And in Canada, you know, for provinces, the 30-year part of the curve is quite liquid, and it's very attractive to us because it moves a lot of things out of the way, and, you know, particularly in periods of heavy financing. So when it comes to curve steepening, we're not traders, we're issuers. I don't think we play many games ahead of that. You know, hedging might buy you a few months worth of savings, but in the long run, it all just comes back to what are your debt servicing costs, and the debt service bite in Alberta is quite low. So I would happily pay up a little to go up the curve and throw a few $1 billion out of the way for a few years.
Great. And for you, Elizabeth?
When you look at our program, I just mentioned $42.8 billion, and you look at a 52-week year, and then you take out the times where you're blacked out because there's an economic release coming, potentially a ratings event, holidays over the turn of the calendar year. You're really looking at a province that is on pace to issue roughly $1 billion a week, every week you can. So when we talk about being constantly in the market, I would say that we are sort of the poster child for that. And so we're averaging in across the year. And so we're not, to Steve's point, picking moments in that sort of very precise way or trying to, beat the market. We do have mechanisms in-house with our debt management team that allow us to manage different aspects of our issuance and the overall yield of that issuance. And that's how I would say we manifest sort of a strategy in terms of terms and timing. But when you think about it, investors are very interested in your credit when yields are high and spreads are wide, which tends to be the exact opposite of when you would most like to issue your debt. So you do have to have some mechanisms in place to help you bridge between those two perspectives and get that issue into the market at a level that when it is fully baked on your end, you're also happy with. So I think you probably have some similar strategies as well, but really it's an averaging through the year and then some management in the back.
For us, you are the market, so we just play off you.
We're a bit of a benchmark, yes. Yeah. That once a week thing sort of gives you that halo effect, yes.
So let's. I just want to touch on this before we finish up, but I just want to get your thoughts on generally what's going on with the federal situation and the amount of debt that's being projected there. Speaking with Stéphane this morning, he sees a $100 billion deficit. It's quite large, but a lot of these outlays are intended for fast tracking large major projects, some of which are in your provinces, are starting to be on the list. Maybe just talk, if you could, just on how that impacts your provinces in general, and whether you see some opportunities there moving forward.
I mean, for us, it's largely an exogenous, impact. Yes, $100 billion is a large deficit. Yes, the federal government is on a very different fiscal track than we are in Alberta, and they have a very different fiscal mindset. But that's a sovereign national government with an agenda. We would like to see more of those capital projects in Alberta, I'll tell you that. But if they're in the national interest, we're supportive of them. And Canada has a long way to go before running deficits the size that they're talking about is going to create an issue fiscally long term. And do they get downgraded if they run these for the next few years? Probably. But we used to be AAA, and we're not anymore. Changed after I joined. I don't think they're related. But so what, right? It's kind of my point. Canada has tremendous fiscal capacity. There's maybe 9 AAAs in the world. They're not any better off than we are. And I think smartly spending the money on capital projects that genuinely change the structure of the country is money well spent.
And to just add to that point, one of the discussion pieces is, so the projects in Alberta, let's say, as an example, and it's a pipeline, where's the steel for that pipeline coming from? Well, maybe from an Ontario steel plant. So I think we also have to be careful not to pigeonhole these projects as being specific to to one province, because one of the things that's obviously under discussion is interprovincial trade barriers and making sure that we are working as a country, coast to coast rather than north-south, more of an east-west perspective on some of these things, and hopefully that's what percolates through as these new programs come underway.
Great. So we've got 50 seconds left. I'm not sure I can get any more questions into you folks, but thanks very much for joining us. It's been a pleasure.
Thanks very much,
Thank
Eric.
you. And
thanks
thank
to
you
Bloomberg
to Bloomberg and to any investors that are buying our bonds. We're delighted you're doing that, and we encourage you to keep doing that. Thank you so much.
Thanks, everybody.
Please welcome to the stage Isabelle Laurent, Deputy Treasurer and Head of Funding at the European Bank for Reconstruction and Development, for a conversation with Bloomberg's Olivia Raymond.
Sit with us today to talk about sustainable financing and how we are incorporating ESG principles into helping the world transition into a more sustainable place. We have a lot of ground to cover, and I want to start with the regulatory environment. The world we're in today, the regulatory world we're in today, is shifting drastically, whether you're in Europe under the CSRD, under the Trump administration, the ISSB in Asia. You sit at a very unique vantage point from your bank to be able to see how all of these different regulatory changes are impacting your issuers and your clients. Could you talk to me a little bit about sort of what you see as the most impactful changes that are happening right now?
Thank you very much, Olivia, and thank you to Bloomberg and National Bank generally for inviting me to speak. I think the role of regulation is really about focus on transparency. So one of the big challenges is that we don't have a global regulatory environment. We've got the NGFS, the net greening of the financial system, where central banks are coming together and they're having a dialogue that at least helps to try and coordinate certain aspects and how to think about transition and sectors and the kinds of financing that we want to see. But in terms of the individual bond markets, they're really focusing on their own ideas about transition. And it generally works well when things are moving in the same direction. But when you have a big partner that's pulling back a little, there are other bits that are worried about whether or not they're paying too high a price for the degree of transparency and the push that they're having. So there's some concern about that, and we're certainly seeing some potential rollback in Europe on trying to ensure that the cost for corporates and others in focusing on sustainability is not so high that it's creating an uncompetitive environment in Europe, whilst trying simultaneously to ensure that we still have the momentum and push in the same direction. And they have a challenge because they're saying, well, perhaps you could disclose less. And there's a question about who should disclose less. Is it corporates with, 1,000 employees or 800 or something less than that or something more than that? But there are also a lot of funds and investors who have their own clients who are demanding that they understand what is being financed, that it moves in line with their own goals, not just the goals of things like the Paris Agreement, but broader sustainability goals. And so there is a sort of tension between the information that they need and want and that which the certain corporates are going to be able to produce or issuers are able to produce. And sometimes the data is quite difficult to get. So there's also a concern about using proxies or other things. And quite often the types of reporting are so specific, they don't tell you very much about whether things are moving in the right direction or not. They tell you a bit about where you are at time zero.
Mm-hmm.
So
who do you think's the leader right now? Like, who is the world looking to when it comes to ESG and climate regulatory disclosure?
Well, I think Europe is still very much ahead because it started its EU taxonomy. It's a very difficult taxonomy to follow. So there are a lot of assets that are very important to finance for the transition, which aren't necessarily going to be covered by the taxonomy. They haven't dealt with all the different areas of investment that we need to see. And they have quite a lot of sectors, but it may work for certain countries within the EU, but the EU has global companies with global projects, it has global investors who have global portfolios, and issuers who raise money in many jurisdictions. And that's one of the challenges of having very contained sectoral views and geographic views that are too narrow, that don't try and take account of all the different geographies in which projects are being financed and where investors are.
And in the past, we've spoken about this myth of carbon footprinting. Can you tell us what exactly you mean by that when you talk about carbon footprinting from a disclosure perspective?
Well, I think that the issue for me with carbon footprinting, and it's a bit about what I was saying, what it tells you about is where you are now. It's what would be called an externality. So if you take the carbon footprint of your current portfolio, it doesn't tell you whether you're going to be in line with the goals of the Paris Agreement or not. It only tells you where you are right now. And actually what's important is about where you're going, not necessarily where you are now. So one of the great difficulties is there are lots of challenges in actually coming out with a quantification of a carbon footprint. For certain industries, it's easier than for others. In bank portfolios, it's incredibly complex with all the different kinds of clients that they have. I should imagine for the provincial issuers, it's likewise. It's very challenging when you're dealing with many different sectors. For the energy sector, it's perhaps a little easier to come out with a carbon footprint metric. But given that the whole point is to say, if I undertake this project, this is what I expect to be the positive outcome for the environment, this is how I'm moving in the right direction, it doesn't tell you about that.
Got it.
It only tells you where your starting point is. And one of the greatest difficulties is when you have investors that are focused on their portfolios, and they say, well, I'm going to reduce the carbon footprint of my portfolio progressively year on year. One of the best ways of doing that is not investing in the most impactful things they can. So what we really need to see is a crowding in of all the hard to abate projects, all the high emission projects that we need to transition. So, you know, manufacturing of cement and steel and the energy sector generally, agribusiness, all the things that we really need to be moving in the right direction because they're not even close to near zero or net zero right now. And we absolutely won't achieve the goals of the Paris Agreement without it. So if you need those to happen, we need investors to invest in them. And the minute they do invest in them, that carbon footprint, i.e. where they are at time zero when they've invested, goes up, not down. So if we focus unduly and a lot of the regulatory reporting start saying, please report on carbon footprint, all you do is dissuade them from investing in the most impactful things that they probably can be doing at this point. So yes, you can invest in a new renewable project, and that's great. But we need so much more than that. That won't help the totality of the economic transition that we need to see.
Luckily, we have a lot of smart people, including many in this room, who are up to taking on that task. But yes, it is extremely complex and it's going to take a lot of resources. You were talking about investors, and I want to switch over to the issuer, especially since at Bloomberg we love talking about bonds and financial instruments here. Can you talk a little bit about who your issuers are and what type of financial instruments you offer to them in order to help their sustainable transition?
So, well, we're the issuer. That's my role as head of funding of EBRD. So we issue, but we also encourage others to issue bonds. So EBRD's clients can get loans from EBRD, but we can also encourage them to access the capital markets. And the one really positive thing about the use of proceeds market, the green bond and social bond market, is that many investors who want to achieve significant impact like the transparency of the disclosure and will take credits that they wouldn't take on a standalone basis. So it's not enough to have sort of general notion of where the issuer is. They want to know the issuer is on a journey and the money is going to projects that they can assess and understand and determine are important for transparency. So a lot of investment funds which shy away generally from things like sub-investment grade will in fact buy green bonds that are sub-investment grade. And when people talk about greeniums,
does that still exist?
It certainly does for those types of investors, because what it's really about is supply and demand. So the demand for use of proceeds bonds is much higher than the supply. And the demand for the bond of a just investment grade or sub-investment grade issuer is going to be far smaller than it is for one of their use of proceeds bonds. And so that's what gives the greenium. For multilateral development banks such as EBRD with AAA ratings, we're very fortunate that we've got a broad investor base for any bonds that we issue. So yes, it's true that there are some very specific pockets that will potentially buy you through the level. Actually, it doesn't increase the universe that much of your investor base. It's pretty similar. It's just that some have very specific pockets that they're trying to fill. And so it never really existed in a meaningful form, I would say, for AAA issuers, whereas for the just investment grade or sub-investment grade, it can be very meaningful.
That makes a lot of sense. And can you tell the audience exactly sort of what type of entities are your issuers? Are your investors? I know you work with banks in Canada. Could you give us some insight onto that?
Yes, I think all the banks in Canada have been very focused on integration of ESG, as well as supporting the green bond market. It was funny, yesterday we were listening, I think several of us in the room, to somebody giving a speech saying that they thought that ESG was not for investors, it was for governments. And I was amused by that, just trying to think, well, you know, if your project is consumed by fire or extremes of temperature or drought or various different things, clearly there's a sort of economic impact that's being measured. And I think that is well understood. In North America generally, I mean, there's a lot of tendency to assume that the US is not on that path. There are still substantial pockets of money that are focused on it. So investors are a mixture of insurance companies, pension funds, asset managers, but also the banks are significant. There are some central banks that have pockets that are specific to that. But we definitely see some plenty of dedicated funds that are focused on use of proceeds bonds, but ESG integration more generally.
And in terms of, you know, the work that you do in your issuance and sort of the countries that you're looking to help, can you talk a little bit about biodiversity and sort of how you work with, you know, more developing nations in Europe and other continents to sort of achieve that?
Yes, it's been far more of a focus recently, trying to think about not just climate mitigation and adaptation, although that can also come into biodiversity as well. So thinking about stresses and how to have nature-based solutions. So in some of our geographies, you see substantial water shortages, which again speaks to climate adaptation, but also flooding that happens. So looking at rivers and planting of trees in certain areas, correcting river courses, having floodplains. Those are the kinds of things that we focus on in some of our projects to end up with nature-based solutions to very specific problems, which may or may not relate to climate particularly.
Got it. We have time for one more question, I believe, and a tiny pivot, but I want to talk about defense and how defense spending, particularly in Europe, but all over the globe, has been rising. And with that has been an increasing component of defense money being earmarked for climate emergencies and disaster relief. Can you talk a little bit about how defense spending and sustainability can coexist with one another?
Well, I don't think that defense spending, that ESG considerations are antithetical to defense spending. On the other hand, I mean, EBRD is not focusing on defense at this point. And I think that the sustainable finance market is focused a lot on transparency, and the kind of transparency that isn't really going to be very aligned with defense investments. So, you know, trying to report on how many tanks you're investing in or what kind of machinery may be less likely to hit the kind of use of proceeds bond market. But I think you also have to be very mindful of where the investments are going and who the end users are and what form, because defense and offense use the same kind of instrumentation.
Absolutely. So. Well, we're out of time. We could talk for many, many more hours about this, but thank you so much, Isabel, for your time.
Thank you very much. Thank you, everybody.
Please welcome to the stage Thomas Brown, Senior Portfolio Manager at Export Development Canada. Andre Delgado, Lead Funding Officer at the Inter-American Development Bank, and Samir Ibrahim, Financial Officer at the International Finance Corporation, for a conversation with Bloomberg's Paula Sambo.
Hi, I'm going to start with an easy question, just to warm up. Are we reaching sustainable finance fatigue? And how do you do real impact this, instead of just box ticking? Could you start, Thomas, please?
Yeah, sure. I think there definitely has been a bit of a shine kind of get taken off the ESG just as inflation and global trade has kind of hit some headwinds. But we are still seeing a lot of demand for our green bonds, and we're also getting more questions about ESG as well, just from normal investors in our kind of vanilla fixed rate bonds as well. So it's still top of mind for both our customers and our investors. And I think like within Canada, we had Bill C-59 recently, which kind of helped address some of that greenwashing side of things to really make sure that like when people are saying stuff in public that there's science to back it up and a concrete plan in terms of moving forward for net emission reductions.
Are the kind of questions you getting the same, the ones that you were getting before, or have these questions changed recently?
Yeah, they definitely have changed a little bit. So before there used to be a lot of focus on what our use of proceeds are, what we have actually allocated to our green bonds as well. And now we're starting to get more questions about what is EDC doing as a whole for all of our lending. So one thing we do at EDC is we do have an ESG review of any lending we do, not just ones that are going to focus on being part of a green bond or sustainable bond.
Okay, what about you, Andre?
Yes, thank you. On the Inter-American Development Bank, we issue in sustainable development bond format, and we also issue bonds that are not labeled. The proceeds for both types of bonds finance essentially the same projects, which is the projects of IAGB, which are all sustainable. And because of that, some years ago, when we had a conversation with Bloomberg analysts, and Bloomberg is now tagging all the bonds, the sustainable development bonds, and the non-theme bonds with the sustainability tag. And the reason is because the proceeds of our bonds finance the projects of the bank. They do not finance operating expenses and other things that are financed with the bank's lending spread. So on that sense, we also have a new product that we launched recently, but we haven't yet launched any bond out of this framework, which is the Sustainable Debt Framework. And that framework will allow us to issue green and social bonds. And we haven't started yet, and that's a very specific framework that has a very clear use of proceeds. The Sustainable Development Bonds is generic use of proceeds, but the Sustainable Debt Framework has a very specific use of proceeds language.
And when should we expect to see the first bond coming out of this framework, and where?
Yes, we completed the 2025 program already, so our program goes from January to December, and we even did already some pre-funding. I would say 2026.
Which geography should be the first one, do you think? Which geography, which country?
That's open for discussion, so we have a few options. So we lend to 26 borrowing member countries, which are the countries in Latin America and in the Caribbean. We do have also one potential initiative, which is the Amazonia Forever initiative, which basically looks into projects for the Amazonia region and takes into consideration the specific needs from the peoples that live in that area. We are talking about 8 countries that are members of the bank. And on that umbrella, holistic umbrella, we could also issue Amazonia bonds, which is another framework that was launched recently together with the World Bank. And the idea is to provide guidance for countries to issue bonds associated with projects in that region. That said, the IAGB can also issue Amazonia bonds as a means to catalyst or to also initiate the funding for this particular product as well. And this, the Amazonia bond will be done under the Sustainable Debt Framework.
Okay.
Again, a project for likely 2026, given that we have already completed the 2025 program.
Okay. What about you, Samir? Do you think we've reached fatigue?
Well, the short answer is no. I don't think we reached that, but I think we need to be very cautious here because there has been a trend on focusing on the numbers rather than the quality of work done by the investment community. And IFC as an institution has been working so hard to develop its green and social bonds principles and to also embed the ESG in its fund structures and term sheets when it comes to the individual project level. We have a sustainability framework and we have also access to information policies that organizes how we should disclose our ESG data, especially that we are working with private sector and we are binded by NDAs most of the time. And also we have our performance standards, and those are 8 performance standards that we require our clients to use to assess and manage ESG risks. And those are very comprehensive standards. We are talking about environmental and social separately. We're talking about general health. We are talking about acquisition of land and indigenous people and cultural preservation. So it is very comprehensive, and that's why we are considering this on a project level, not just on a holistic level.
Okay. And where do you see the biggest gaps in mobilizing private capital, Samir, like today's, and I'm talking geographies, sectors, and regulators?
Yeah, sure. So sector-wise, we are seeing the biggest gap in infrastructure. And especially those related to digital infrastructure when it comes to payment solutions, which is very important for financial inclusion in developing markets. The second one is access to clean water or clean water projects and clean energy. And also a big gap we are finding is in MSMEs. And actually that's reflected in our portfolio exposure, where the second biggest exposure for us is in infrastructure and the first exposure in financial institutions. And the way it works for us is that we rely on financial institutions, in local financial institutions, to lend to MSMEs to further support them because they have better knowledge of the markets. I mean, IFC has a presence in 135 countries, and we rely on our country offices to locate investment opportunities. But at the same time, we believe that financial institutions are the ones who really have knowledge of all of the details of the local markets. In terms of geography, I would say the poorer countries usually has bigger gaps, and this is because of the perceived higher risk included by investors. But I think the most difficult one to tackle is actually the regulatory uncertainty, because regulatory uncertainty is very idiosyncratic to each country, depending on the geopolitical environment of each country. And on the other hand, investor wants enforceable contracts. They want predictable rules. And that's where the challenge comes. As I mentioned, we work on a decentralized basis, which means we rely on our country offices. And through those country offices over decades, we have very strong relationship with all IFC stakeholders, including governments, including regulators. And through our projects, either it's direct investment, either it's through mobilization, either it's through advisory or public-private partnerships, we always try to close this gap. Lastly, I would just like to highlight that the World Bank Group in general is collaborating with the CEOs of the biggest companies worldwide in something called Private Sector Investment Lab. And in this lab, they gather twice a year to address the barriers to emerging markets. The biggest barrier or the top of the list of these barriers for this lab is actually regulatory uncertainty and how to come up with this regulatory framework that is outcome-based rather than, politics-driven to some extent.
Okay. And Thomas, with industrial policy surging abroad, how does EDC ensure Canadian projects stay competitive?
Yeah, very interesting question. And we have kind of seen a development or really over the last kind of few weeks in terms of really a big focus on major products within Canada, in particular kind of expanding our LNG resources, getting shipped out of the West Coast, development of the Port of Churchill in terms of getting critical minerals and other grains and potash out to the European market as well. I think a few other people have talked about the new small modular nuclear reactor project that's being done in Darlington in terms of how that might help commercialization going forward in terms of a resource. So I think we are moving forward in the right steps. I think in particular, just as kind of Canada has faced some global trade headwinds with our biggest trading partner in the South. So I think we are seeing kind of this focus on major projects in terms of getting that infrastructure ready for helping Canadian companies kind of move forward, but still doing it in a sustainable way.
Okay. Andra, you mentioned the Amazonian Fund. And I'm wondering, how does the IFC can actually help the Amazonian, via the bonds? What would the bonds finance and how would that work?
The IAGB, yes.
Yeah.
So well, basically, we are looking to finance projects that look into deforestation. That's one aspect of it, protecting biodiversification, and also supporting small farm holders and MSCs and MSMEs in the region. And I'll take into consideration the specific needs of the region and following in terms of the indigenous groups, respecting indigenous transitions. So that's one aspect. The other one is through productivity and innovation. This is a new project, so we are using part of the experience of the bank in similar sectors, and maybe not necessarily in the Amazonian region, but in other regions. We look into synergies as well between our organization, the IAGB, and the IGB Invest, which lends specifically to the private sector, as well as the IGB Lab, which is also part of the IGB group, but they are looking mostly in technical cooperations and work primarily with donors and grants. So we look into synergies between the three organizations to make certain we are addressing the specific needs for that for the peoples in that region. And again, it's a new initiative, relatively new. We are weighing with experience that we gain. The bank is a knowledge base as well, and we very much like the cross-pollination aspect of the bank, and that's how we are looking to move forward with projects in that region.
Thank you. Now, Samir, actually from IFC. You mentioned about perceived risk. So how do you address the perception that emerging market risk is mispriced?
Yeah, that's a very good question, actually, and I think it's very important to ask ourselves this question. I think the first factor in determining whether something or an asset class is mispriced is actually the number of investors participating and the amount of trading happening. And that's what IFC and pretty much all the MDBs is trying to do, which is to not only invest from their accounts, but also to mobilize capital. And that's how we increase the number of investors participating in developing countries. The second part is the data. You need to have data to analyze the fundamentals of the asset classes. And there is a very, very good initiative that's done as a result of calibration of all DFIs and development partners, which is called the Global Emerging Market Risk Database.
Mm-hmm.
And this database analyzes the credit performance of developing countries over 30 years. And the results is very interesting, very, very interesting, in my opinion, because the average default rate in emerging markets right now is 3.6%. and the average recovery rate is around 72%. That's actually very high to the perceived risk that we have. The other important observation is that using the implied default risk from CDS spread of sovereign countries is not the right way to assess and price assets of private sector, because private sector does have a different behavior when it comes to paying back debt. So using that implied risk from the sovereign states is actually kind of overstating risk and unnecessarily increasing the premium. So I hope that this database will be used in evaluation and pricing of investments of developing countries across the globe. IFC also recently issued the Emerging Market Securitization Program, which is a CLO-like structure where you have a standardized exposure, or investors have a standardized exposure to different loan portfolios with different exposures to certain industries and some limits. And then there is a tranching happening where the first tranche is AAA rated, the second tranche is mezzanine, and then the last tranche is equity based. And we use the data from this database to price those, this structure. And we hope to see more of it in the future.
Where are Canadian institutions uniquely positioned to lead in sustainable finance, and where are they lagging?
Yeah, I guess in terms of where we're really performing right now is in terms of our resource sector and the necessary resources that are needed to kind of help green the world economy. You know, point to things like uranium and critical minerals that we're looking to expand. So obviously there is that environmental hit when you're first doing the mining, but then the rewards come later on when you're not needing to have that same continuous way of doing it. In terms of where we could probably look to start doing a bit better is probably on our transition story in terms of how we're starting to move from some of these hard abate sectors to start reducing the emissions. And I think that's quite a long process. Kind of within EDC and our sustainable finance framework, like we do offer transition financing. But the one thing we've seen is there hasn't really been that pickup in demand for it yet. Like as much as we can offer the loans, we need someone to want the loans. So I do hope that like eventually that starts becoming more of a thing and we start seeing more demand for those products in terms of transitioning. And I think we're encouraged by, yeah, there's still being strong demand for, you know, ESG type labeled bonds.
Andra, 10 years from now, will development banks still anchor global capital mobilization, or will new players take that role, in your opinion?
Well, we always welcome new players, so there is a lot to be done in our region in terms of financing and ESG financing. And on our side, we are focused on the economic development, social and financial economic development of the countries in the region. And there is many opportunities there in terms of some of the topics my colleagues already mentioned. Keep in mind that we at IAGB, we finance a bit different because we finance countries and sovereign guarantee loans. We don't finance directly into the private sector. But in that sense, we do finance projects that would encourage the initiatives from the local government in terms of especially productivity and innovation, as I had mentioned, but also rule of law and infrastructure. It's interesting that Thomas mentioned transition finance. It's another opportunity there as well. We have products already in terms of green energy and renewable energy, as well as climate change, especially disaster recovery initiatives as well. So if, for instance, one of the projects, when is contingency loans in case there is a hurricane or earthquake, the bank is to some extent counter-cyclical, so that we are there to support our countries in those situations.
What do you think, Samir?
It is, I mean, in general, I would say that, you know, closing the gaps is very important. but also addressing different topics that causes divergence between private sector and between the FIs is also very important. So topics like investment horizon should be closed. Like investors normally expect in developing countries longer time horizon in terms of investment. And usually it's not easy in developing countries, so it needs to be more and more specific. And this is something that we've been working with investors. Also, I would say one of the things that we also talk to investors about is the amount of, is the difficulty of reporting the data, meaning that for our social team, for example, we can report the data, but how the new job, we can talk about job creation, but what are the quality of the job being created? So we always invite investors to be part of that and to give them the complete picture about how we view our added value locally.
Okay. We only have a few minutes left, but I'd like to hear from you, Thomas. Do you think what happens 10 years from now?
Well, 10 years from now, I hope global trade continues to grow. I hope that we move along this path in terms of transition and addressing some of the environmental concerns that we have globally. I think Canada is in a good position to kind of help with that transition as well. Like, we have the critical minerals, we have the resources, we have the knowledge to really kind of drive this going forward. And we are seeing demand for our products as we go along here. So yeah, I hope continued trade and continue to working with people like IFC and IDB as we kind of move into new markets and kind of sharing knowledge amongst ourselves.
Okay. Okay. Thank you for having us, and thank you for giving your very valuable insights.
Please welcome to the stage Jillian Brown, the Chief Investment Officer for Public and Private Investments for Ontario Teachers Pension Plan, for a conversation with Bloomberg's Derek DeCluett.
Well, thanks very much, Jillian.
Thank you for having me.
We are the closing act here.
Yeah,
so
exactly.
Thanks to everybody for
sticking around,
staying all day, and let's jump right into it. You manage some very important pensions, the pensions of some of my family members who are Ontario teachers. You've talked about putting more emphasis within the organization of making sure the investing team is focused on what's our edge. If you're taking active risk, there needs to be an excess return and so on. And I'd like you to start by delving into that investment process thing. What kinds of decisions have you made at Ontario Teachers to focus the team on where's our edge?
Right. Edge is one of these terms people use a lot, and when you try to define it, it can get a little bit looser in practice. I think it's important to understand that Teachers has a portfolio that is built out of a foundation of assets, are what we call an all-weather portfolio construction that is really based on being able to manage through different potential scenarios where growth and inflation can perform differently than expected by markets. So that's our foundation of returns. On top of that, we take active risk in areas where we think we have an edge, and that's to the extent that you think you can generate excess returns. So where do we focus? Traditionally, Teachers has been very strong in private asset investing. We were one of the first pension plans to be investing directly in things like private equity, infrastructure, timber assets. There were a lot of innovations in the Teachers portfolio, and so we had some first mover advantage there. I'd say some of that translates into edge today in the sense that we have the capabilities to invest in these asset classes. We have a long history of being there, and so we're somebody who tends to get calls by people who would like to partner on various assets, so it puts us in the flow there. I think having the pool of assets that we have and the history of investing also means that we've partnered with other organizations over the years. We invest through funds as well as directly, and so we have access to a lot of smart funds, smart partners for assets. And so again, that helps us both be able to see what interesting sectors, geographies they're focused on, what their pipelines look like, what their fund age looks like, what kind of assets are they interested in buying or selling, which can help build flow for us. So we think about those things in terms of the business. Now, I think some of these markets have become more challenging for, I'd say, primarily just because of the reset we've seen in real rates over the last couple of years, and that is still pricing through markets. And so we have to be sort of looking carefully in the mirror around what has changed in these markets and how does that impact our edge or not. So if I can give one example would be our real estate, we had real estate managed externally by a Canadian owner and operator of assets, it's Cadillac Fairview. And as we were expanding our real estate portfolio into globally, I guess, so into other regions, and also it was predominantly office and retail focused, and we wanted to get more sector breadth there. So we asked Cadillac Fairview to do that for us. Now, that was not their edge. Their edge was developing and operating properties in retail and office in Canada. And so we made the decision beginning of last year to bring real estate in-house because we want more of that investment focus. Both you should be a buyer and a seller at any price on any asset, right? Not really attached to the assets you hold, and we felt that was best managed within an investment total portfolio construct within Ontario Teachers, and so brought real estate in-house for that reason.
Let's talk a bit about the environment and private equity, because of course we had the shock of rates a few years ago. 3 years ago at this event, we were talking all about interest rates.
Yeah.
Then obviously that pressure has lessened, but other pressures have come in. So give us your sort of taking stock of what the opportunity set looks like for you as a large investor in private equity.
Yeah. I think, interest rates are certainly part of the picture there. I think private equity has been a very successful investment strategy for many years for lots of different investors, for us as well, both directly and through funds. What we've seen is that with, the reset in interest rates certainly impacted the ability to leverage the assets you own and generate higher returns for higher risk, but generate higher returns out of those assets. I think we also saw a real re-rating of multiples in privates versus public markets, where private multiples had started to become quite highly valued. There were some pretty high multiples through the post-COVID low-rate flush into private assets. And so when you're modeling private equity, I think you have to understand what the drivers of your return are. And to the extent that interest rates or leverage and multiple expansion was part of that calculus for your expected returns on assets, you have to recognize that those just aren't providing the same tailwind that they might have in the past. With that, I think the question is, how do you generate returns out of private assets? And for us, that means refocusing on actually the operating company level results. So how do you drive revenues, drive efficiencies in companies? And so we formed a group within Ontario Teachers. We took some asset management professionals from across all the different asset classes and brought them together into a team called Portfolio Solutions. And so that team now sits with our deal team from the moment they're looking at an asset and working on the valuation, both to buy that asset, but how are you going to drive value over the life of that asset and sell it? And they sit with the deal teams and go through, these are the 5 levers of value creation we're going to focus on. We think we can take this measure from X to Y. If we do that, it will create X amount of revenue or reduce cost by X, and that will be the driver of the returns. And so there's a much more of a, I'd say, getting back to old school private equity, where you're actually improving operating performance versus being maybe as focused on financial engineering in private equity.
In terms of fund investing, some of our reporters have heard that some non-U.S. LPs are starting to price in higher risk when investing in U.S. domiciled funds. Mm-hmm. Is that the case, whether they're private equity or hedge funds or whatever it may be? Is that the case for Ontario Teachers?
No, not. I wouldn't say there's like a pricing for U.S. Every asset is assessed on the risks of that particular asset. I think when we recognize that there's more uncertainty or a wider range of potential outcomes over an asset that we hold, you're going to price that in as increased risk and ask for an increased return to that. But I'd say that's on an asset-by-asset basis.
As opposed to looking at the U.S. as its own sort of unique case. Is it, let's talk about public markets for a moment. Is it possible for a fund of your size to generate excess returns in public equities right now in this environment? And if that's hard, what do you do about it?
I think it's hard to be clear. It's hard for any fund to outperform, let's say, S&P 500 public market returns, which have really been incredibly strong over the last couple of years. And that's true for public or private assets. It's a hard benchmark to outperform. We still have conviction on the private side that over a cycle, we should be able to generate excess returns over public markets. Our experience, and this goes back to the earlier question around how do we define our edge, know where we can actually build conviction and add value to the pension. When we look at public markets, it's something that we've approached from multiple angles over the years, and we have not found a real sustainable angle in that kind of fundamental public equity investing where you have a sort of a better grasp of the valuation of a company than where the market, happens to be settling in terms of a clearing price. And that, I think, is just public markets are, in the U.S., quite efficient, right? You've got a little bit of this tension between, if you want inefficiency in markets, you have to go to less liquid markets. So by definition, there's less that you can scale there, right? And so there's going to be some tension between where you can find opportunities. I think some investors do better in that space. It's something that we haven't had a lot of success in. We still have success internally on a quantitative basis, investing equity long-short programs. And I'd say also we see partners like through our external managers, hedge fund partners who are very good at exploiting, I'd say, more deep expertise in inefficiencies between very distinct pairs of stocks, et cetera, where you can go both very deep but also trade at a much more rapid pace than what would suit us in terms of our internal investment strategies. And so we still have that risk. We've just tried to figure out where is it best that we can do that investing directly versus give it to an external manager.
Right. So speaking of that internal, external, let's talk about private credit. How do you guys handle it? Where are you focused, and what's the stuff that is, in the we're not interested category?
So in private credit, it's something that we had a presence in that market, I'd say, for many years, just quite small. It was something that in 2020-ish, I can remember. It's that, COVID from when you were at home for long periods and having all the video calls. It was all video calls when we were talking about starting a private credit mandate. We initially got exposure through funds because, again, lean on your smart friends who have the origination networks. They have the ability to work out distressed names, et cetera. Where were we going to build those capabilities besides sitting beside a partner and learning with? So we started with fund allocations. I'd say over the last couple of years, private credit as an asset class, it has improved in the all-in yield side, but the spreads have been fairly tight, and we think of it as a spread product more than an all-in yield product. So as that came in, and you're sort of still paying external managers the same kind of returns over hurdle rates, that hurdle rate is now being assisted a lot by just base rates rather than actual outperformance. And so as that kind of shift between the value for dollar, I guess, to external managers started to shift, we started bringing in more and more of that capital and hired up a team to manage that. In terms of where we go or don't go, our credit team manages across the spectrum of public to private. So the opportunity set is very broad. I like that because it means we're always calibrating those two markets, one to the other, and making those choices about which market is better priced than the other. I think issuers seem to be increasingly going to both markets simultaneously, or certainly comparing between. And so we feel it positions us well to be competitive in that market. The only area where we don't tend to play is really in the investment grade space, which again I think turns into more of a duration rate product rather than a spread product. So we don't tend to do a lot in that space because we don't see it as being a good source of excess returns without sort of excess leverage to get to the return hurdle you need.
All right, I've got, in the time we got left, 2 AI-related questions.
Okay.
The first is about, really, it's about the market environment, and I'll avoid using the word bubble, but is the space overheated in public markets?
Is it overheated? I have a colleague who says like the overheated stocks can keep on getting overheated, whether you call them that or not, it doesn't really matter. I mean, I'd say it's a point certainly of concern. Valuations are pretty high. We do take stock against, these are companies that are generating cash flow. So, you know, people make the distinction to the kind of intranet bubble in 2000 where we're not at those kinds of PEs by any measure because these are real companies making real earnings. It's a big CapEx spend. It's something that we as a fund have aligned with in terms of, you know, the data center space where we've been invested in the development and operation of data centers. And also certainly in the energy space where we have a fair amount of investment in the generation and transmission of electricity, which is one of the big needs for the AI piece. So I'd say we're trying to be thoughtful about where we play this space and where we think the risk reward is better and where it sets up better with our skills, frankly.
All right, and so my second AI question is about how you use it and how the people on your investment team use it within your investment process today, and where might you be going with it?
Yeah, we use AI internally. I think it's as good as the data that you can feed it. Our data has not been, on the private side, it's not been something that we have ever built or with a view to let's make this accessible to AI. And so we're playing a bit of catch up there and trying to get our data into the shape we want it to be able to point it to 35 years of investing, right? There's a lot of pattern recognition value that could be generated out of that. So we're excited about that. I use it now, certainly when I'm scanning through emails, when I'm prepping for my week, when I think about the concerns I have that I'd like to scan through what underwriting committees are looking at and get a sense of where the whole fund is going. So I use it quite heavily. I think our teams are using it a lot in some of the very early stage of looking at, you know, market scans, et cetera, where they might have gone to consultants outside. They can do some of that internally now. And then obviously the big concern for us is we're a big holder of private assets and making sure that we're looking at that portfolio of private asset companies and considering who's going to be disrupted here and who has an opportunity for better returns and trying to get ahead of the disruption and align our companies with the return opportunity.
Yeah, have you made any specific moves yet on the basis of that concern that you hold
yes.
things that?
I'll say yes.
Yes.
And leave it at that.
You care to,
No details to share. And
all
yes.
Right. All right. Well, we'll read your next annual report with interest. And thank you so much
Absolutely.
for taking the time today.
Thank you very much. Thanks.
Thanks, Gillian. Thank you. So that's it. Thank you so much. We hope you had as much fun listening to all these presentations as we had delivering them to you.
Yes, and thank you to our sponsor, National Bank of Canada Capital Markets, for making this event possible.
If you would like more information on National Bank, please visit the Resources tab on the event website, which is bloomberglive.com. That's bloomberglive.com.
And we've really appreciated you being such an engaged audience during a very content-packed day. To rewatch any part of this event, you can return to bloomberglive.com or YouTube or X or LinkedIn and view on demand. And as you probably know, we will be convening for networking and refreshments right outside those doors. Thank you so much.
Thank
you.
Have
a great night.